last year really was thinking about real Fed funds rate. We think that the Fed wants real Fed funds rate to be at 1.5 or 1.6%. So then it depends on where you think inflation would be.
Right.
And we think that inflation would be hanging around 3.5 to around that vicinity, starting around the middle of this year.
Right.
So that's how we get to that.
Okay, that's the monetary side. What does the job economy do in this? It is Jobs Day. Maybe we're out front of where we'll be in May or in August, but what is the job reaction function to the Anna Wong 5% call?
Yeah, I mean, so economists right now are still pricing in a terminal rate of higher than 5%. So there's a difference between traders and economists right now. Traders think that the terminal rate is at 5%. Fed will cut by 40 bips by the end of 2023. Economists think it will peak at 5.25, and the Fed won't cut. So where we stand is that we do think the terminal rate would be at 5, just because that I think that the near-term downward momentum on inflation is actually pretty strong given what's happening in China and commodity prices. And even in terms of jobs, I think that the headline number today from non-farm payroll would overstate the tightness of the labor market because, last December, in the middle of December, the early revisions came out. So the jobs report we're getting today is based on only a sample of firms. It's not the definitive number. And once every year, BLS revise all the numbers in March, where they use a census population of firms, where that data is a definitive data of what's happening to the jobs market. And that number, we got an early preview of that number last December, and it's not looking good. So I think that the labor market is actually cooling faster than what the robust non-farm payroll number would suggest today.
Well, is that perhaps what the market's sniffing out? Because we talked about the dissonance between the market and where economists are. And honestly, markets tend to be correct, and economists haven't had the best track record over the past decade or so, or even longer. So at what point is the market sniffing out exactly what you're talking about? Perhaps a little bit more slack in the labor market than currently being represented by headline numbers, a rapid disinflationary kind of pulse. How much is that going to really push the hand of the Fed later this year?
Well, for sure, the traders, markets have put their money in where their mouth is. But I do think that the economists have a comparative advantage in understanding what the Fed's reaction function is, and that the Fed is serious about not cutting. So I think the market is still a little bit, over-optimistic the Fed will cut, but the economists are right that that the wage persistence underlying inflation is stronger, whereas the market thinks that inflation will become a non-story by the end of this year.
So as an economist, I want to go to the question that John's been asking quite a bit of the Fed, which is, where is the balance of risks right now? Is it equally balanced between hiking too fast and torpedoing the economy and fighting inflation, or is it still asymmetric towards fighting inflation despite some of the disinflation that you're talking about?
Yeah, I think that given all the things that we know today and the data we have in our hand, the risk seems to be balanced. We are seeing data that inflation data that seems to be surprised on the downside rather than upside now. However, I think the battle that the Fed is fighting, and they are definitely learning from the mistakes they had last year, is that there are all these unforeseen shocks that could come on in this uncertain world. There may be labor strikes, union strikes later this year, or just unforeseen shocks that could derail their whole inflation fight. And so from a risk management perspective, you want to come out ahead of that, because inflation expectations are still a little bit fragile to any additional shocks.
And a great call last year. Just great to catch up with you. Thank you. Anna Wong there of Bloomberg Economics, looking for that 5% terminal rate when it was not in fashion back in the summer of last year.
Stunning call.
Fantastic
Priya Misra, it's two calls of the year.
Priya's coming up in a moment.
Yeah.
And I go back to what Priya said a number of months ago when she said 2s10s could go through 40 basis points, maybe threaten to go to 50. And here we are at negative 74. No one talks about it anymore. It doesn't even come up in conversations that I have.
Well, part of the reason why is because even the person who really kind of founded the yield curve model has poo-pooed this question of whether it actually is predictive of recession this time around. So there is a question of whether it matters. That said, the fact that we've gotten comfortable with this tells you how far we've come and perhaps how much people are perhaps overly sanguine about whatever it might be suggesting.
Yeah, I don't want to jump on board about the predictive nature of the yield curve and all that good stuff. I just think when you're willing to accept a high yield in the near term and a lower one in the longer term, says something about where we're at.
You can dismiss it, you cannot dismiss it. This goes back to what we were saying. You could pick a data point, emphasize it, de-emphasize it, and then craft a narrative around it. But you're right. I totally agree with you. It says something really significant when you can earn more going into a money market fund than you can to lend to this country for 10 years.
If the 10-year is lower than the 2-year, it says something about where investors' heads are at.
I am a traditionalist in that, and what's important, folks, for those not paying attention, is the vector over the last 15 days has not been discussed, which is I'm seeing negative 75 basis points right now, John. A huge body of our audience is not aware of that new further inversion.
Priya Misra will have some things to say. I have to say also, TD has the biggest call on payrolls for this morning. They're looking for a punchy number, so we'll get some more on that with Priya
I didn't know that.
in just a moment. She comes up next
Font of wisdom.
from TD. Do you not go through the estimates, Tom?
No, I don't know the estimates.
It's good to know.
Word of what Conti will do.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Right now, what we're seeing is a very strong job market.
The Fed has to drive up the unemployment rate sufficiently to slow down the economy, to generate slack in the labor market.
What we're likely to see is slower and slower and slower non-farm payrolls.
It's important not to get distracted by what's happening with the layoffs in the tech sector.
It's industry by industry. And that is why this is such a difficult labor market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
New rule. In a new year, payroll should come out on the second Friday of the month. Doesn't feel right.
I agree.
Not excited about it.
Okay.
You
so
want to be depressed, John? Do you want to be depressed?
Go on.
Somebody on Twitter goes, more talk of debt default in the 7-hour silver plates. I can't.
Oh, they want Bramo.
They want
to weigh
Bramo.
in.
You and I don't exist.
We'll catch up with AMH in about 20 minutes down in DC, and Bramo's going to run you through the risk of a debt default in the United States of America. Live from New York City this morning. Good morning to you all. It is Payrolls Friday. We're looking for something like 202K. That is in our median estimate in our survey here at Bloomberg. Range is pretty wide, though. You can go to Nomura at 130 or TD at 350. Tom, in about 2 minutes' time, we'll catch up with Priya Misra of TD as that firm looks for 350,000 this month.
With our guests, we're going to do this differently, folks. Priya Misra here with a fixed income angle on obviously the depth of the fixed income market. Then Tom Porcelli coming up, and he owns Wage Dynamics. I want to talk to him about the wage number that we'll see at 8:30.
Above consensus, Tom Porcelli in the jobs report, and Bramo, that's been the place to be over the last 8-9 months or so.
Here's the issue. What do you do with a 350,000 payrolls report? What do you do with a real blockbuster number? Do you buy stocks? Do you sell bonds? How do you respond to it at a time when the Fed will look at this as a green light to go hard against inflation and create some real pressure?
You would expect at the front end yields up, and you'd expect in the equity market stocks down. That's what you'd expect.
Right.
What happens by the time we get to the end of the day, I've got absolutely no idea.
Especially if people are saying, well, you can kind of look past these numbers. There's a weakness around the edges.
Sure.
And you can see disinflation elsewhere.
Well,
so then this is just going to end up creating profits for the companies and better than expected kinds of earnings.
You do two things. One, you listen to John Farrow talk to the Secretary of Labor. I think we'll get some color from that. But the other thing you do is you listen to Michael McKee, who goes beneath the headline data. And it's not just about 202 or the unemployment rate or 6 other numbers. There's some real nuances under there that can show which part of the economy is moving which way. That's what I'm going to do.
Russ Kostrick, BlackRock, said it. It depends where you look. Industry to industry, very different
I agree
stories.
with that strongly.
And tech and what's been happening with tech jobs hasn't really spoken to the resilient labour market data we've had through most of this week. Equity futures right now on the S&P 500, totally unchanged. Unchanged on the session. The S&P down on the week for a 5th consecutive week. Tom, we'll see if we can change that a little bit later this morning.
And this is, this is underneath, folks. This is like 11 ratios. Good morning, Michael Rosenberg and his team who invented this. The Bloomberg Financial Conditions Index moments ago, John, moves out to new accommodation. Let me double check that. Yeah, we're buttressed right up against more accommodation away from restrictive. This joy in jobs we're seeing and the data that we've seen the last number of days is pushing against where Chairman Powell wants to be.
Is that a problem? Is it a challenge
for Powell? It is. Yes, absolutely. Absolutely. I do agree with the gloom crew that you need restriction. You know what Dudley's saying, you need higher rates, and the market's pushing against Bill Dudley, Mohammed El-Arian. You know him better than me, John. You keep track of this. And the answer is the restrictive crew is looking for help right now.
Bramo, which one is it? Full Bullard or full Kashkari?
And does it matter in between? Honestly, did you ever read those children's books, Choose Your Own Adventure, where you could basically figure out which way you wanted to go and then turn the page to that particular outcome? It feels like that is what we are embarking upon in 2023. And so today, the adventure that I'm going to be looking at is for sure going to be the wages one. With 8:30 a.m., December payrolls report coming out, do wages come in hotter than expected? Perhaps that gives more of a sense of the strength of this labor market, more than even the headline number. At 10 a.m., the other side of this story is the services sector that has been the strongest, that has been really the driver of a lot of the recent inflation. We get ISM Services Index for the month of December. Do we see it continue to go down the way that we saw with some of the durable goods, with some of the manufacturing, with the ISM that we saw earlier this week? Or does it come in hotter than expected, showing what the Fed keeps talking about, which is there is resilience in this economy? And if you are looking for some more Fed speak, we're going to get it with a number of people, quite a few number of people. Atlanta Fed President President Raphael Bostic, Fed Governor Lisa Cook, Richmond Fed President Tom Barkin, Kansas City Fed President Esther George, as well as, of course, a host of others, Ben Bernanke, among them former Fed chair, as well as the chief economist of the ECB. Do they all go full Kashkari? Is there a difference between full Bullard and full Kashkari? Or is this basically the same story of a Federal Reserve that wants to raise rates to about 5%, maybe a little bit north of that, and keep it there for a long time, John?
We've got to stop saying full Kashkari and full Bullard now, haven't we?
Are you banning it now?
Neil emails in from Minneapolis.
One too many times. Priya Misra joins us now, Global Head of Race Strategy at TD Securities. Priya, fantastic, wonderful to hear from you as always, and a Happy New Year to you and the team. Tom wants to talk to you about the yield curve. I just want to set the stage with the estimate over at TD of 350,000. You're above consensus, Priya, at TD. Why is that?
So the high frequency numbers that we're tracking for the labor market, they're still very strong. So the seasonals, in our view, are going to add 250,000 to that number. So it's just, there's a lot of talk around less hiring intentions, layoffs. But the overall high-frequency data for the labor market is still very strong. I think, businesses are hoarding labor. And so I think the labor market's always a bit of a lagging indicator. It's going to be much more of a lagging indicator because we're going into the slowdown with a very tight labor market. Right. So our view is if you're looking for weakness, it's probably not going to show up today. I'm looking at more high-frequency numbers, ISM services, that revenge spending in services. Is that starting to moderate rather than in the payroll report today?
Priya, I want to go back to your home run call last year on curve inversion. We're celebrating. We had Anna Wong just on with a great terminal rate call from Bloomberg Economics. We were here December 15th. How is the inversion today, the re-inversion, I should say, to 75 beeps? How is that different from the inversion to 79 beeps only, 21 days ago?
I'm glad you brought that up. I think there is a big difference. The inversion that we saw in, I would say, November into December was more recession fears. I think the market became extremely pessimistic about, growth prospects in the very near term. The growth data, I have to say, over the last month is still strong, and we expect another pretty strong payroll report today. The inversion, the more recent inversion, I think it's a global rate-driven inversion. If you look at what's happened with bonds, and why have bonds moved that much? It's more sort of optimism around the inflation view. And I think the market may be a little too optimistic that inflation, I think, has peaked globally. But how quickly does that decline? Our view is it's going to be persistent. It's service-driven. It's very broad-based. It's hard to see how we get from 7% CPI to 2% this year. So I think the market may be a little bit misplaced. But, our view is that the Fed is serious. It's not a reaction function issue. I think the market understands the data remains strong. They're going to keep going. So our view is that inversion might actually invert a little bit more. We might even get to minus 75, minus 80 on 2 stands as that terminal rate pricing, I think, goes up. Our view is 5.5. By the time the Fed is done, they're going to have to raise rates at least to 5.5 by the middle of the year, maybe even higher. I think nobody's talking about higher. What if inflation doesn't decline? What if service or wage inflation stays high? I think they're going to have to keep, at a slower pace. They can go 25. But I think they're going to have to keep hiking, and that will just prevent that curve from steepening because at front end rates will keep moving higher. The long end is a longer term issue. Is growth slowing down? Is the market positioning for a recession later in the year? That's why I think that inversion, I think we have to get used to an inverted curve all this year in our view.
What you're saying is pretty shocking, actually, and it's a pretty significant call. Fed funds rate north of 5.5%, possibly with upside potential simply because of how much strength there is, which really goes in the face of even what the Fed themselves are saying, which is that they want to raise rates to a certain level and then hold it there to digest what the effect will be. Why do you push back against that and say, no, they're going to look to crash this economy, which really is the scenario that you're talking about?
Well, I think it comes down to the economic data. Our view is that things don't slow down really until the third quarter. There's still that savings buffer. You look at consumer spending, it's staying very strong. The labor market is strong. Businesses are hoarding labor. I think it's just going to take a while for the cracks to show up. Maybe the cracks are showing up, but on an aggregate basis, with the unemployment rate at 3.7, 3.6, we think today, I mean, the Fed, which I thought was stunning, their forecast in December was that the unemployment rate will rise to 4.6. That tells you their tolerance band. They need the unemployment rate to go up. So that's going to require multiple negative payroll numbers. We think we're very far from that. So the Fed, in our view, they're signaling 5.25. But really, it's going to come down to timing. If they're going to hike, we think 50 in February, then they're going to downshift to 25. What do they do in May? We think another 25. June. By June, is there enough in the economic data that makes them stop? Or do they go another 25? That's the argument for going a little bit above. We think still 5.5. They can get there, stay there. Remember, QT is also ongoing, which I think matters a lot more. It's not talked about enough. Those 10-year real rates are high. That's imposing a lot of stress, I think, to companies, to households. So I do think the economy is going to slow down. We're actually calling for a recession in the third quarter. But I think, can the Fed respond with inflation high, with wages high? I think they're going to struggle to respond. So I think the market pricing in of these 40 basis points of cuts by the end of this year, I think that's too much. The Fed is going to be late. I think they'll be forced to just sit tight at 5.5 or wherever they end up, until they see signs that the labor market has cracked enough where the unemployment rate is above 4.6, I think, for them to start to cut rates.
Priya, this was fascinating. What an outlook over at TD. Priya Misra there of TD Securities. Happy New Year to you, Priya, as always.
So
I'm not sure it's
depressing.
a Happy New Year for anyone who had to listen to that. So let's go through the calls. 550 on Fed funds, curve inversion through the whole of this year. Recession may be at the back end, and a Fed that's unable to respond to it as it waits for the labor market data to really crack.
I'm going to dovetail here. This is really important, folks, what you heard from Misra of TD Securities, and this is on the x-axis, the time function. Curve inversion for the entire year. Dovetail that with Deborah Cunningham, not on the sell side, on the buy side at Federated Hermes in Pittsburgh. And Deborah Cunningham is saying you're going to be lucky to clip a coupon this year. Dovetail those two views together, and this is the when of it. Out the x-axis across this mysterious year.
The essence of the argument that Priya is making is you're not going to get that rally at the front end of the curve. You're not going to get that steepness that comes from the bull steepener, which is when the Fed starts to cut interest
I think Brambo
rates.
needs to be medicated.
Basically, the argument she's making, you get to 550, you wait there, curve inversion the rest of this year. You're not going to get bailed out with rate cuts.
Okay, Lisa?
I'm just fascinated. I'm great. I think this is really interesting. I could dig into this for the rest of the show.
Equities unchanged.
Forget about
Payrolls.
jobs day. We're doing bonds with Brambo.
1 hour and 20 minutes away from the payrolls report in America.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Today's U.S. jobs report will help determine what the Federal Reserve does next on interest rates. Now, the estimates are that employers added fewer jobs than last month, and that indicates a cooling in the labor market that would reduce the need for higher rate hikes. But data released Thursday shows that the job market is still resilient. Inflation in the Eurozone has returned to the single digits for the first time since August. And that's fueling hopes that the bloc's worst ever spike in consumer prices has peaked. Prices in December were up 9.2% from a year ago. Slower growth in energy costs was a big reason. And Republicans making history on Capitol Hill. Party dissidents have blocked Kevin McCarthy from becoming Speaker of the House on 11 ballots. That's a post-Civil War record. The standoff has left Republicans fractured after they reclaimed the majority. McCarthy has offered concessions to hardline conservatives, but so far he hasn't been able to get enough votes. And the clock has started on Vladimir Putin's 36-hour ceasefire in Ukraine for the Russian Orthodox Christian holiday. Ukraine has dismissed the truce as a ploy. President Volodymyr Zelensky called it a bid by Moscow to get a break in the fighting to step up the war. That holiday travel meltdown is prompting Southwest Airlines to revise its financial outlook. The airline canceled more than 16,000 flights over the last 11 days of the year. Southwest estimates that it cost it up to $425 million in lost revenue. It expects to report a net loss for the fourth quarter. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. The first jobs report of the new year.
The labor market has not cracked.
A lot of that's a function of labor shortages.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Can you walk us through how the Federal Reserve conversation has reset?
We're still seeing a strong economy, so the Fed has to do more.
Why are people so confident that there is going to be some massive deceleration?
I just don't see the evidence.
This could go a lot of different ways.
The December jobs report, today on Bloomberg Television and Radio.
I found it interesting. He was ready to bomb hospitals and nurseries and churches, and on the 25th and New Year's, and I mean, you know, I think he's trying to find some oxygen.
The President of the United States on Russia. We'll continue that story in just a moment. From New York City, it is Payrolls Friday. We are 1 hour and about 12 minutes away from the payrolls data, looking for something in and around 200K. Your jobs number just around the corner. Your market action looks like this on the S&P 500. Futures totally unchanged on the S&P 500. Yields higher by about a basis point on a 10-year to 372.53. And euro-dollar following Eurozone CPI a little bit earlier this morning. CPI on a headline coming in softer, but core is still a problem for this European Central Bank. Euro-dollar a break of 105. Tom, 104.92. We're negative there, a third of 1%.
Yeah, but DXY with a little pop rounded up to 106. I mean, there's some really interesting trends here in the jobs report. I don't want to underplay it, John. You know,
no, I hear.
There's some. I'm riveted on the Bloomberg Financial Conditions Index. You can look at the other ones if you want, but I mean, they're all there. Let's do this. Let's dash to Emery Horton in Bloomberg in Washington, and we're going to pretend Kevin McCarthy doesn't exist. We've been, overwhelmed by this story. It is, for those of you internationally, there's no other story in America about right now, but let's pretend there is. And within the warm weather of Europe, Emery, it is a ceasefire by one side in the war. Just let me go to the basics here. Do you have any reporting that Ukraine will honor the ceasefire?
Zero. And they've come out and said that publicly. They really view this as a ploy and a sham. And as you heard the president say coming into your program, the fact that Russia had strikes on Ukraine during the Western Christmas Day, during New Year's, which in the Eastern European, especially Ukrainian, Russian cultures is an incredibly important holiday to celebrate. Why would he stop now? And largely everyone just views this as breathing room. And really, you have to just caution, and we've been saying this for years now, you have to really be able to look at what Putin says and what actually he does. So for the Ukrainians, it makes no point to abide by this ceasefire, give Russian the room they potentially need to move around some military, to move around some ammunition, and then come out and strike on them. They don't want to give them any inch.
Total unfair question, but you're good at this. Emery Horton, I believe the zeitgeist is Ukraine is winning the war. Does President Biden, the Secretary of Defense, do they think Ukraine is winning the war?
Well, they haven't actually come out and publicly said those words. What they have said is that they will continue to support Ukraine until the very end. And the fact of the matter is that Ukraine was able to get back about 40% of the land that Russia was striking on very early on. And at this moment, over the past prior months, what you have seen is Ukrainians being able to really push back on Russia. And in that sense, when you're looking at the picture right now, it does look like Ukraine is in the lead in terms of winning this war. This is why you have, which also is a testament really to Putin, a testament that the West is going to band together. You have some, I think G0 called it light tanks from France, but really heavy duty infantry tanks coming from Germany, coming from the United States. That number's almost 100, and then another Patriot missile battery coming from Germany. They want to make sure that Ukraine can keep this up.
Anne-Marie, I wanted to talk to you about that. Germany's contribution. I think Olaf Scholz, the Chancellor, has been criticised many times over the last year about a lack of contribution from Germany to the war effort in Ukraine. How much of a big change was that?
This is a huge change. I mean, it's not as many as the Bradleys that the United States will be sending over, but still, it is a huge directional change, especially the Patriot missile. Think about this. The United States is also only sending one, and they decided that last month. And now you have Germany falling on the heels of that U.S. decision also, and this is something Zelensky has been asking for. They said, we do not have the armored materials, the tanks, similar to the way the Russians have, and we need to be able to close the skies. And with the Patriot missile battery, they are one step closer to doing that.
How much is this really also making good, Anne-Marie, on this pledge to reach that 2% threshold of GDP, to reach NATO of spending in military? How much is this really ramping up rapidly of Germany to fulfill this pledge for the first time, really, in decades?
Well, it certainly is. And exactly, that's the point. In decades, Germany has fallen far away from that 2% target for years. And what you're hearing from NATO, what Stoltenberg is talking about, is that potentially NATO may just change this all to not be a 2% aim, but a 2% minimum for NATO alliance countries that you have to be able to spend on defense budget. And what Germany is doing is maybe just potentially getting ahead of that. But as Jonathan said, they've come under a lot of criticism, and at this moment, they are coming to the Ukrainian help.
I'm sorry, AMH, we got to go there. We have a wonderful listener out on Twitter who was very polite. He said, can AMH talk about the debt default silver plates? So let's go there right now. Alexandra Harris writes it up for Bloomberg. Are you kidding me? We really have to talk about a debt default now?
Well, people are concerned, although the markets don't seem to be concerned at all, and they just are shrugging off the theater that is going on the House floor. But people are concerned that if Kevin McCarthy is unable to get his own party to even vote for the basic, what is largely ceremonial, his speakership, how is he going to get these individuals to vote to lift the debt ceiling? And this is why so many people are saying this should have been done in the lame duck session. But obviously those Democrats in the House didn't have those in the Senate side to go on board with it. And this just sets up a huge fight.
Yeah.
This, we're starting to hear whispers of it now, and especially in the circles and the individuals we speak to. Wait till the early summer. If this becomes an issue, this is really going to start to, I imagine, freak out many individuals on Wall Street.
John Alexander Harris has a drop-dead date of sometime in late summer. Cancel that vacation.
Late summer?
Late summer.
Is that coinciding with Jackson Hole?
Yeah, that's
Late
very
August,
good.
Around that kind of time.
That'll be good. We'll have the
That'll
full
work
attention
out.
of
full coverage.
the institution.
Late summer. That's hard to look out for, isn't it? To really start to discount and think about. Don't you think, Lisa?
Are you just setting me up? Because
I'm interested in your thoughts on
Jackson Hole?
I was thinking about why markets are not responding more to the potential for a debt default, since that seems to be imminently where this House is going to, this House of Representatives. And you said, well, it always gets fixed, right? You say, well, who cares at this point? But then this is the issue. This is the issue. This is ripe dysfunction in Washington, D.C. We have seen this movie before. In 2011, it had a serious effect on markets.
Yeah,
What's going to stop us from getting back to that point, considering this doesn't set a very good precedent?
Almost every single time we do this, we buy treasuries, right? Is that going to change anytime soon?
That's the real question, right? What is the implication for markets? Is it the haven trade, sell stocks, buy treasuries? Does that equation change now that inflation is a concern, that the Fed's monetary policy is a different kind of tool to offset any potential disruption? Does that change the narrative? And I think that that's a great question. I mean, honestly, you could say debt default, but what that's going to do on markets,
The
who
Washington Post
knows?
takes it back to 1862.
Oh, that's fun.
And then 1933.
Okay, and what did we learn back then?
We learned that McCarthy could be speaker. Who knows? I don't know. I got to go back and watch Lincoln this weekend.
Can we just predict the jobs number in an hour instead of what's going to happen?
That would be
maybe
simpler to
late
do, to
August?
stay focused. You're 26 minutes away
Try
from
and
what
work that out.
matters.
Got no idea what that looks like either. Tom Porcelli's going to join us and talk about it of
Did
RBC
we thank
Capital Markets.
AMH?
I think we did.
Was
Did
it?
you? You were meant to wrap that up.
Anne-Marie, thank you. We appreciate it.
Bye, Anne-Marie.
That's your bye.
That's it.
Sound like the Sound of Music or something.
That's what he sounds like when he ends phone conversations.
He sings.
Yeah.
Manus Cranny used to do that. He'd
Really?
sing like Disney songs, though. Really strange
Is
stuff.
that when he hung up or when you hung up?
2 in the morning in London, he'd be on the phone to someone who'd start singing Disney songs. I never understood.
You're going to be talking to Marty Walsh
Never
today, and
understood
he's going to go climb every mountain.
You think he's going to sing?
He's going to sing.
I doubt it. Can we talk about Tom Porcelli coming up next?
We should. He's
Who's
very
got
good. You're
Another
trying.
above consensus call on payrolls, I think, so we'll break that down with him. Some of the calls coming through, 350 at the high end, Nomura kind of towards the low end at 130 or something like that. 200,000 is your median estimate in our survey. The payrolls report about an hour away. Futures not doing much. Unchanged on the S&P 500. Yields high by almost a basis point. Your 10-year 372.53.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
60 minutes away from the payrolls report in the United States of America. Let's get straight to it and check out a price action for you. On the S&P 500, we're going absolutely nowhere on the S&P. Unchanged this morning, down on the week. I said it a few times already this morning, heading for a 5th consecutive weekly loss on the S&P 500. Longest losing streak on a weekly basis, going all the way back to May. Looking at the bond market, shaping up as follows. Through Thursday, yields lower on a 10-year by 15 basis points, a big decline in the face of some pretty resilient labour market data so far this week. We can touch on the ISM and what's happening with the PMIs a little bit later. But for now, your 10-year, 372.35, your 2-year, 447.29, and the call from TD's Priya Misra in the last 20 minutes or so. Fed hiking rates to 550 and pausing. Yield curve stays inverted all year. Recession begins in the back half. That's just the US. Let's talk about Europe. Euro dollar shaping up as follows on the euro, the single currency, in and around 104 today, 104.92, break of 105 a little bit earlier. We're negative a third of 1%. And as I mentioned, Tom, CPI in the Eurozone, still a problem for the ECB. It is not moving in the right direction for core, at least. Well, the headline coming in maybe in the way people anticipated.
This is important 2 days ago, and frankly, John, your core analysis on Europe is more important 48 hours on, because Cunningham and Misra both say extend the duration. What if you extend core CPI? What does it mean for Lagarde? Frankly, what does it mean for a rebuilding Germany, the fiscal support that Ukraine needs? All these questions are more enhanced than they were 2 days ago.
We closed out 2022 with Chairman Powell, I think, reflecting on a more balanced outlook than perhaps he was looking at a few months previously. But for the ECB, I think we've got to remember this as we closed out 22. We all took that nice long holiday. I hope you did at home too. And then forgot that the news conference from President Lagarde over at the ECB, that was the most hawkish ECB news conference I have ever seen with President Lagarde.
Oh,
Tom, she was so blunt and to the point. There was no on the one hand this, on the other hand that. It was, we're going to go again, we're going to go again, and we need to do a whole lot more.
She's got to speak to her constituencies, and that was, let's call it a Bundesbank speech, not to editorialize, but...
Hey, Tom, I couldn't agree with you more. That was a Bundesbank news conference. In fact, picking up after it, I almost said that was the Bundesbank meeting over at ECB HQ.
How have we
exactly what it felt like.
How have we had a data-free 2023?
We're going to sort that out soon.
We've been back for 4 days.
He took another 4 days on.
Is that it?
I know. You said it's already been a long year.
It is a day away from saying Happy New Year, no more, right?
Yeah, that's what you said.
That's the deadline.
You told me that. I stopped immediately, and you already
haven't said it. You haven't said it.
I haven't wished anybody a Happy New Year. All right, well,
growl.
You've never wished anyone a Happy New Year.
I'm just kidding. I wished you a Happy New Year. I wish everybody a Happy New Year. Happy New Year.
You didn't mean it.
Can we talk about some interesting moves that are going on in the market right now? Tesla. Look at Tesla shares. They're down more than 6%. And the why of this is more interesting. Those shares have absolutely been bombarded. We've heard about all the situation with Elon Musk and questions around shareholders, what they want to do with him. But the latest one is really more interesting from a fundamental demand issue. They are lowering their prices further in China, which now means that certain cars by Tesla in China are more than 40% cheaper than cars in the U.S. of the same kind of make. Just to give you a sense, what this suggests is a real weakness in demand and a difficulty in competing with local brands. This raises some serious questions, and it's not just for Tesla.
96, it was under $100 in August of 2020, I believe. That's when we were last there.
Well, this has been a really marked move, and it really suggests a broader slowdown, which people are wondering about. Bed Bath & Beyond, we were talking about yesterday. They filed a going concern, potential for bankruptcy. What's interesting to me is that those shares were down almost 30% yesterday. Today, they are down more than 14% in pre-market trading, just to give you a sense. And I'm looking at Lululemon because Wells Fargo raised them to overweight, and I'm curious whether people are going to keep buying clothes to run in, even if they're heading back to work.
Lululemon wardrobe's a little light.
Do you know how I saw running yesterday? Loved it.
We started laughing.
So I come back to work because I do double shift. You know how you guys clear out.
Oh, give me
So I came back to work at about 11. Bramo runs out, just like sprinting out of the building. Sprinting. You know, people come out for a run after work or something. I don't know if you do that. I don't do that. But you might come out and just sort of like warm up, gauge the temperature, how you're feeling, sort of stretch out a little bit. Jog lightly. Bramo just comes past me, whoosh, like sprint.
He just starts laughing. He's carrying a suit and looking really, debonair. He was hysterically laughing.
Can't stop laughing. Do you do that every day?
Yes, I do.
You sprint home?
I sprint
Do you maintain that pace as well?
Yeah, I do.
For how long?
For a half hour.
That is nuts.
Well, how else do you have efficiency? If you have kids, you're juggling work, you want to make sure you get your reading in.
But that's a real pace you were at.
Yeah, it's just...
Call that a martini.
What were you running away from? Just getting away from work?
what are we doing next?
Let's
Tom Porcelli
save ourselves with
Exactly.
I guess I'll bring in Mr. Porcelli. Tom Porcelli with his folks, and when you become acclaimed on Wall Street, there has to be a reason, and his reason dovetails with payrolls today. He is definitive on wage dynamics. Tom Porcelli, what do you look for with Mr. Powell's wage inflation metrics this morning?
Good morning, all. Is it too late to still say Happy New Year? I don't know how that works.
You can still say it. Go ahead.
I heard Lisa doesn't say it. Is this right?
Fake news.
So first of all, sorry I'm not able to be on video. I guess we had some issues here on our floor. But look, Tom, I think there's countless ways of looking at wages, and in fact, I would actually argue there's too many ways of looking at wages, right? I mean, I think a lot of people made a big deal about yesterday's ADP report with the job changers number, still remaining pretty firm. It's funny to me that people talk about how it's at 15%. Oh yeah, but it's down from like 17%, right? I mean, and again, I'm not saying that's not a big number. It's an enormous number. But if you look at like the Atlanta Fed's wage tracker number, they have the similar number, sort of a job changer number. That number's half the pace. So I just think, just as a PSA, let's just be careful with all these wage numbers and the rates that they're running at. But what I think is definitive, no matter which one you want to look at, is they're all doing the same thing. They're all rolling over. Now, again, I think people hear rolling over and they immediately jump to this sort of this end result of, oh, well, that means things are, really going to sort of, get tossed in the trash. That's not what we expect. I mean, we expect that there will be continued slowing, but you're getting back basically toward where we were pre-pandemic. That's a totally reasonable outcome. In fact, I think that's a great outcome. And that's probably where we're going with this. So, if you look at our growth forecast over the course of 23, it's, and again, consistent with what I've just said, it's not like we expect, economic activity is going to fall into the tanker here. It's not going to. I mean, we think it actually be fairly decent, but it's going to slow.
Tom, link together today's labor report and your relative optimism there with a hugely accommodative trend for whichever financial conditions index you want to look at. Bloomberg BFCI this morning is a shocking negative 0.19 standard deviations. Link the new accommodation trend with today's labor report.
Yeah, look, and I think it was as deep as minus a standard deviation, I think, right?
Negative one.
Yeah, exactly. I mean, look, I think that the bottom line is we're still in a very accommodative backdrop. That's just that is the reality of where we are. We think that as a result of that, again, there's an irony in all of this on some level. I mean, Q4, the Q4 that just passed. I mean, that might have been. We'll get that number in I guess another couple of weeks. That may have been the strongest quarter for growth in 22. Right? I mean, who would have thought that? Sort of given everything that's happened here. What we know as the quarter was coming to an end is that the consumer was losing some momentum, right? I mean, and I think that loss of momentum will certainly drag on into Q1. But again, I think Q1 will be a positive number. I just think it's going to be less positive than what was
hold on a second.
Q4. So the level of accommodation I think still remains fairly accommodative.
Tom, I want to get your sense, and I was really looking forward to having you, especially after Priya Misra. I'm trying to square this idea that there's real strength in the market. You're seeing a bigger than expected jobs number that will come down the pike in a little less than an hour. And yet you still think that the Fed is torpedoing the economy by continuing to raise rates and that they shouldn't go much further and that really they've done enough. How do you square those two ideas?
Yeah, I think it's actually pretty easy. So one of the things that I think we need to be mindful of is that there's been an enormous amount of accommodation removal put into place, right? I mean, this is the most aggressive hiking cycle that we've seen. What we need to be mindful of is what is the Fed really trying to achieve here? They're trying to basically slow inflation, right? I mean, I think that it's been pretty clear. And the reality on that is inflation is slowing down. Now, we can all have a reasonable discussion or argument or debate or whatever about the degree to which it will continue to slow down, but I don't think it's debatable that it is slowing down. We think it'll actually slow down pretty meaningfully over the coming year for reasons that I've outlined many times in our notes and on your show. So our view is, if it's already happening, right, if inflation is already slowing down, and you already have signs, nascent signs to be sure, that labor is starting to slow. And again, we're above consensus for today, but we think that there are signs that, we're going to continue to slow down. Then we would argue that it's no longer necessary to continue to be as aggressive as the Fed has been. And look, here's the thing, at least, and I guess the punchline on all this is maybe the joke is on us, because this hiking cycle is virtually over, right? I mean, we have the Fed getting up to 5.25 by the time all is said and done. So that's just 2 more meetings away, basically, by the time the Fed is done with this hiking cycle. So I think the Fed is acutely aware of this, too. I think now the question is, how much slowing have they actually put in place, given their aggressive hiking cycle? And that's, I think, where sort of the debate is probably going to sort of sit for 23.
Hey, Tom. Happy New Year. This was great. Tom Porcelli of RBC Capital Markets. Thank you, sir. And sorry about the technical problems a little bit earlier. TK mentioned Neil Dutter of Renmac, then right on cue. This popped up in the inbox. Here we go, Tom. Real incomes will be strong in Q1. Neil says, in addition to gasoline pump prices, households will see 2 tailwinds for disposable income. Number 1, he says food prices, and 2, utility bills. He goes on to say, TK, unless the labour markets completely fall out of bed, an unrealistic assumption given what we are seeing in claims, surveys, etc., real incomes will look very strong this quarter.
Across the Bloomberg moments ago, Nat Gas, 18-month low in New York trading. Dovetails right into it.
He's seeing a re-acceleration in the economy, and I think that speaks to what Tom Porcelli of RBC was saying just moments ago, that 4Q, Lisa, could well be the best quarter for economic growth of the year.
But then he says that there is enough deceleration that the Fed might be toward their end of their hiking cycle. The difference between what he was saying and what Priya Misra was saying to the same potential strength is massive. With Priya Misra saying that the Fed's going to have to go much further, and Tom Porcelli saying not so much. They can sit here and wait, which is 2 very different views.
Can we have a moment of Jobs Day silence for Matthew Losetti and Deutsche Bank, who nailed the win of a recession? They were laughed at when they said late 2023.
We're not there
yet.
yet.
Laughed at.
How long should the silence be?
I don't,
A couple of seconds?
Yeah, a couple of seconds.
All right, go. Thank you, Matt. Appreciate it. That was nice. Was that for Deutsche Bank? Are we still calling it the Time Warner Center, or is it the Deutsche Bank Center now in New York City?
I can't get there.
Well, do you call the Triborough Bridge the RFK Bridge? Does anybody do that?
The Deutsche Bank Center?
Can't get
there. I can't get there. Coming up, Dan Ives is going to weigh in on this. He's not. He's going to weigh in on Tesla and Apple up next.
Apple. Well, actually, Tesla 103. Wow.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Kevin McCarthy's fight to become Speaker of the House drags into a 4th day. After a historic 11 rounds of voting, the California Republicans still couldn't lock in all the votes needed from GOP dissidents to hold the position, despite offering concessions on House rules. Now, McCarthy and some of his supporters said they will press ahead with negotiations no matter how long it takes. U.S. authorities are ramping up the pressure on Sam Bankman-Fried's inner circle. Bloomberg's learned they are now scrutinizing one of his close associates at the bankrupt FTX crypto exchange, Nishad Singh. Now, Singh hasn't been accused of wrongdoing, and it's unclear if he is cooperating with investigators or will do so. In the UK, a threat from the head of one of the biggest transport unions. Mick Lynch warns there could be a coordinated wave of strikes involving tens of thousands of public sector workers. The UK is in the midst of a series of strikes involving transport and health workers and other parts of the civil service. In China, Tesla has made another round of price cuts on its Model 3 and Y electric vehicles. The starting price for a locally built Model Y SUV has been slashed to $38,000, 43% cheaper than in the U.S. Tesla is cutting prices as it faces competition in China. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
You do not get get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Big tech is ridiculously profitable. Yes, companies are going to try to manage costs that arguably climbed up a little too much during the euphoria post-pandemic. But the reality is these are still very profitable companies.
That was Russ Kostrick, the portfolio manager at BlackRock Global Allocation Fund. We'll talk about the tech story in just a moment. Equity futures right now unchanged on the S&P 500, almost down about 0.1%, but no real drama here. Yields higher by almost a basis point on a 10-year to 372.53. The tech story of the week so far, cuts. Amazon, Salesforce, the latest tech companies announcing layoffs. The job cuts coming after 2 years of pandemic-era success. Tom Forte of D.A. Davidson weighing in.
If you look at Salesforce laying off 10,000, you look at, big tech company du jour with more layoffs, is that to some extent, there was some element of bloated headcount. So you had a very tight job market, especially in the technology area, and you had companies that ramped their headcount very significantly. Some of it was a miscalculation of demand.
And TK, this is where we are. We've got to unwind some of that excess now, the excess of the last couple of years.
Yeah, there's no question about it. The pandemic blew out. And I'm going to cut a major slack on this. I've said this before, and these are very different businesses, very different margins, but they all did the same thing given a medical crisis. They had to guess.
They had massive demand. But Tom, let's talk about the explosion of hiring. The numbers out of Amazon are just...
They're unimaginable,
They're
but
just
that's,
nuts.
come on, it's the same with their airplanes or trucks. It's unimaginable.
Oh, no, Tom, to add 1 million people to the workforce of a single company in what, 3 years? It's just phenomenal.
We're going to do this. I just used my fancy new iPhone to take an expanded shot here of Lisa Abramowitz, Jonathan Farrow, and our guest Dan Ives. He is Senior Equity Research Analyst at Wedbush Securities, and we're supposed to talk Apple, except Tesla's not cooperating. So we will go over to Tesla printing a 103.00. Do you have in your head a price of Tesla where Mr. Musk's world unravels?
Look, I don't think we're there yet. I mean, but I will say that, look, about $60 to $70 of the sell-off has been Musk Twitter driven. Now, clearly, this part is the demand story, the price cuts that we're seeing in China. But I believe, look, at $100, we're getting to a point that I believe this is starting to get to just a massive risk reward to own, despite going into a Q4 where clearly they're going to lower guidance, and I think that's really the fear.
Can you help me understand the demand backdrop? Particularly in China, specifically in China. Do you think that was off the back of the lockdowns, just a lack of spending more broadly in that economy, or off the back of competition? I'm trying to work out what lasts here and what fades.
Yeah, I think about 30 to 40% of it is what I view as COVID-driven in terms of the lockdowns and really what we've seen in country. But no doubt, I mean, it's an arms race that's happening in China, from NIO, Xpeng to, call it 20 or 30 other OEMs that are really going after Tesla. But when I look at the EV market in China, we're still in the second, third inning. I just view this as the market going from hypergrowth to more moderated growth in the face of a recession.
When they reopen, I think a lot of people would make the argument right now that this is a more nationalistic Chinese consumer. When they reopen and they've got the spare cash to spend and buy a vehicle, are they buying Teslas or are they going local?
Well, that's been the debate, and ultimately the brand of Tesla continues to really be unmatched. And I think that's why if you look at the Chinese consumer, especially on the higher end, if they're going for EVs, I'd say 2 of every 3 is going for a Tesla. Now, the problem is competition, price competition, what does that do to margins? And that's why the clock struck midnight for Tesla in terms of hyper growth. And that's what you're seeing reflected in the stock. Although, as we said, 70% of the sell-off, we believe, has been Musk Twitter driven.
All right, well, and not to get into the whole drama there, but there is this question, if you strip out the 30% that isn't related to that, how much Tesla is representative of a bigger story within the tech sphere, in particular that you're seeing with a lack of demand, a saturation after so much buying of certain types of electronics during the pandemic? How much have we already seen a right sizing in some of the tech companies as they do layoffs versus there more room to actually cut?
Well, first of all, tech companies, if you look the last 4 or 5 years, I mean, they were spending money like 1980s rock stars. So at that pace, if you look at it, that was not sustainable. Clearly now going into a recessionary environment and what I'll call a hangover post-COVID from a growth perspective, you're going to see the cuts. But I view the cuts similar to as I viewed them in 2009 and 2001, 2002. It's ultimately the start of a right sizing that leads to the next upcycle.
Is this Silicon Valley adulthood upon them? Given crisis, and they saved us all with the cardboard boxes when we couldn't go out, just as one example. But is it now finally Silicon Valley, with cost cuts, with shocks financially, finds a new adulthood, a new sobriety to act like other American companies?
I think they're transitioning toward that adulthood, because I think they've learned from their mistakes. And I think also
Microsoft never had this problem.
Well, look, if you look at Redmond and how Microsoft did, ultimately they've been tacticians, as long as I'd say with Apple, in terms of everything that Cook's done. But I think when you look at the rest of tech, I mean, it was really an arms race to really outspend because of the talent level and what demand looked like. And now what's really happening is I think we go into this Q4 earnings, numbers get cut. I believe tech is under-owned today is 2009. The New York City cab drivers bearish on tech. And then I think we sit here February, March, April, depending also what happens on macro. And I think tech stocks rip higher from here, despite sentiment, which, many yelling fire in a crowded theater.
But you think we've got to go through a kitchen sinking moment for guidance?
The kitchen sink has to happen the last 2 weeks of January across the board. And that, in my opinion, marks what I view as a core bottom.
So the real question for a lot of people then is how much more downside is there off the back of that kitchen sinking moment? Or do you think that kitchen sink leads to a rally because you get this relief?
Whisper numbers usually are, I'd say, 8-10% above street. Today, they're probably 8 to 10% below the street. And I think that's the difference. From an institutional perspective, you've already seen buy-side numbers come down across the board. A lot of bad news baked in here. And look, fundamentally, especially on enterprise, software, cybersecurity across the board, I mean, we're seeing 93, 95% deals still get done. And also remember, if you look at Apple, given everything we saw with COVID in terms of China, all the supply chain issues, you would be like, okay, they're going to pre-announce negative, not even a question. They already announced their date. So again, it just goes to a point. Demand, despite what I think, in terms of the clock striking midnight in the eyes of many, I think is holding up better than expected, specifically in Cupertino.
The story of 2022 was a real bifurcation of big tech. It was no longer big tech. It was specific industries that they're catering to with technology as their preeminent business. Are there any big tech companies that you don't think will revive, that you don't think will be underpriced, that you think could kitchen sink it and then have to kitchen sink it again later on this year?
Yeah, I think that's really more on the social medias. I mean, like when you look, let's say, where a Meta play is, that they have significant headwinds because of what's happening on Apple, iOS, and just digital advertising and obviously more money spent toward metaverse. But it also goes back to they cut costs. Look at that stock since Zuckerberg actually peeled back spending.
John, let's look at this. This is the reality. Take a photo, run it to 48 megapixels, which is the new magnificent resolution.
Oh, you love this phone, don't you?
Edit it in another app, throw it out to Tree and House sitting in the studio. She nails it, gets it done, and we get it up in 12 seconds. That's the Dan Ives world.
You love this camera, don't you? Over at Apple.
I do. I love the chip. No, let me rephrase this. Help me here. The chip is what matters. Nobody in the financial media talks about the A this or the A chip in whichever toy you're talking
It's
about.
the biggest innovation to come out of Apple in the last 6 to 7 years in terms of chips. They're basically being Intel at their own game.
Dan Ives, fantastic to see you. Dan Ives,
Great to be here.
Thank you.
Just brilliant. Shares your stylist, TK.
Yeah, he
Similar
does. I
wardrobe.
mean, he's looking great. I mean, you know.
Loving the jacket, bit of colour for New Year. It's great.
This is what we're about. We had Tom Forte yesterday from Davidson and Dan Ives today. These guys are encyclopedic on this stuff. It's not a lot of blah, blah, blah.
Look, for some of these tech firms, think about how long they've been around. They've never had to live with 5% interest rates.
Yes.
And I'd also make the argument in the United States, they've never really faced truly a cyclical test. Because the pandemic for some industries, of course, was a cyclical test. For these tech firms, it was not. They got an acceleration of demand. For many of these firms in their current form, this year could well be, if we do get that recession, the first cyclical test they've faced in the United
That's
States.
a new sobriety I'm talking about. And the other side of it is, and you know, we'll talk to Dan about this in the coming weeks, we're going to go to earnings, I believe, February 2nd for Apple.
27th, I think, January. It's February? What do we get at the end of January?
Tesla,
Tesla's the 20th.
Tesla,
Right, okay.
Microsoft, that'd be the big Amazon.
We're going to go to earnings, and they're going to go, hey, we're selling all these stupid phones through the mobile phone companies for next to no money. John Farrell needs one of these, don't you think?
I don't know if I want to upgrade.
I think Farrell needs an iPhone 14.
Yeah, he needs, you know.
Really?
What is
I think
this,
I'm
the
rocking it. I
shopping
think I'm
channel?
rocking a 12.
Yeah,
Still.
I think I'm. Yeah.
I don't want to change this, Dan. I'm not ready to do that just yet.
We'll see.
You know, what am I waiting for? The 15, the 16?
Yes, the 16.
Okay.
23.
2024, 25.
Keep going.
Something
you know,
like that.
It's good.
It's Payroll's Friday. The jobs number is 34 minutes away. The brilliant Nadia Lovell of UBS joins us next.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Right now, what we're seeing is a very strong job market.
The Fed has to drive up the unemployment rate sufficiently to slow down the economy, to generate slack in the labor market.
What we're likely to see is slower and slower and slower non-farm payrolls.
It's important not to get distracted by what's happening with the layoffs in the tech sector.
It's industry by industry. And that is why this is such a difficult labor market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Jobs Day. Russ Constrid says it's difficult. We'll have difficulty for you in 29 minutes. John, at the minimum, it's complex.
New median estimate, 203. Just ticks hard. Just for you, Tom.
200. That's important. It's important. 200 to 202
Direction
to
of travel
203.
matters.
And that's a lot of inertial, seriously, inertial force.
Hey, look, the labour market data so far this week has been really resilient. If the ADP is worth anything to you, we got an upside surprise from that. Jobless claims came in really low relative to where they've been historically.
204.
You can throw on top of that what we've seen elsewhere with job openings, 1.7 openings for every single unemployed American. The quits rate is elevated. The official labour market data is screaming things are okay. Then you've got a load of other people that think this is as good as it gets and it's going to get a whole lot worse by the time we get to the end of the year.
That's a pundit game that we've got right now. Let's go to something fresh. An hour ago, Neil Dutta comes out and says, I'm sorry, real incomes look pretty good. And they do, because inflation, particularly in certain important sectors like utilities, is coming in a bit. I want to know what Secretary Walsh says to you this morning.
One, food prices, two, utility bills, and the politics. Well, they hope that Neil Dutta's right, don't they? And that the pessimists are wrong.
I
and
do
this
agree.
economy and this labour market
The
holds
president really feels Neil Dutta's right, yes.
Without a doubt. And let's see what happens, Tom. As you say, that's the punditry game. In the here and now, looking at the official data, it's hard to make the argument that things are terrible in the labour market.
Lisa, please jump in here. I got a Bloomberg Conditions Index negative 0.19, which is telling me Chairman Powell, he wants a gloomy report today.
Well, that's what I was going to say, actually. So this administration might want that strength that Neil Dutta is talking about for this year and maybe until 2024. And then it doesn't, because they don't want inflation to keep going. So where does the Feds come into this, when what we heard from Priya Misra was that they may have to torpedo this in a way that nobody is prepared for, talking about north of 5.5% Fed funds rate and holding it there for a year. Nobody is gaming this out with Fed
It's the holding it piece of it that I think is important.
Yeah.
There's two phases to this, and this is what Neil Kashkari of the Minneapolis Fed was speaking to earlier this week. The first phase is the hiking cycle. Now, maybe we've had the bulk of that. Most people assume we have. Then comes the pause. They believe that the pause is a tool. It's a tool. It's not just a moment in time where you stop there for a month and then the following meeting you start cutting interest rates. I think they really believe that the pause is a valuable tool to wait, look around until they're absolutely convinced that inflation is heading back towards target.
We're going to go to Nadia Lovell of UBS on equities here in a moment on the trend you and I have seen in 48 hours. And Lisa, I'm sorry, people are taking that pause and extending it out. Chamberlain of Federated yesterday, Priya Misra an hour ago was stunning on the duration of curve inversion.
And that's why I find it so amazing that the market is still pricing in cuts through the end of this year. So yes, you have economists, you have analysts coming out and saying they're going to hold Fed officials, and the market says, no, you're not going to hold. You're going to cave as soon as there's
John, Priya Misra curve inversion, 2's 10 spread, the vanilla spread negative 76 basis
That's unreal,
points.
isn't it? inverted rather, for the whole of this year is the call from Priya. And for those of you that missed the conversation about an hour ago, TD's Priya Misra is calling for yield curve inversion for the whole of this year. Recession at the back end is the economy call over at TD. And ultimately, a Fed funds, Tom, that goes through 550 and then stays there. That's the call from Priya.
Dollar stronger. Give me some data here, John. I got red and green on the screen. I'm bored.
Equity's down about 1/10%. That's not going to address your boredom, I'm afraid, Tom. Maybe the number in about 26 minutes will. The jobs report just around the corner. Going into that, yields are higher by a couple of basis points on a 10-year to 373.84. Crude's had a really, really interesting start to the year. Got battered the first two sessions. Now in and around, Tom, 73.50 on WTI.
One eye on Tesla here. It's off the radar this morning, but just printing under 103 gets everyone's attention watching the Musk saga. Right now, we're going to dovetail this length of duration, the duration of 2023, and those ramifications in fixed income over to the equity space. Nadia Lovell joins us, senior U.S. equity strategist, UBS Global Wealth Management. What does how much of it, the length of it mean, Nadia? How do equities react to a holding Fed, a longer duration inversion, the length that some of these fixed income types are talking about? What do equities do?
I think it's going to be a challenging market for equities if you have the Fed on hold for a very long time at a very elevated interest rate. That is going to continue to pressure margins. It's going to continue to pressure valuations. It's also going to overall pressure earnings in 2023 as the economy slows down. So I think it's going to be a tough market for the equity market. I mean, even though we have a 3,700 price target for June on the S&P 500, we think that the market is likely going to trade lower than that in the first half of the year as those earnings cuts continue to happen. And we think that that's going to start really with the upcoming earnings season.
So the lows are in our future. Nadia, let me talk about the opportunity maybe away from the index level story. Where do you think on a sector basis that opportunity is?
You know, we think that the opportunities continue to be in the more defensive areas of the market, like healthcare and consumer staples, and also energy. I mean, as you noted, energy has had a rough start to the year, some of that having to do with oil prices, given the rise in COVID cases in China and also a warmer than expected winter in Europe. But we think that those factors that really push Brent above $100 in 2022 continue into 2023. We're going to see continued underinvestment in energy, and also Russia production disruption continues. We see the EU oil embargo that went into place in December, and also we're going to have the refined products embargo that goes into place into February. So we think also, you know, the China reopening is going to put upward pressure on oil prices. So we think that oil gets back above $100 and towards 110, and that should be supportive to the energy sector in 2023.
Nadia, can you give us some color from your conversations with clients? How many of them have come to you and said, why should I invest in stocks at a time where I can get 4.5% reliably on investing in 2-year treasuries?
I think what we're hearing from clients is definitely a mixed bag. I mean, some clients have a lot of dry powder on the sideline waiting for that additional downturn in the equity market to really put that to work. But we are seeing continued interest in the fixed income market, just given where rates are. And that's sort of been our message as well. I mean, we've been continue to recommend high-grade bonds as a way of seeking incomes, as well as structured products where you can get some yield as well as some downside protection if the market should pull back further. So it's been a mixed bag. Some clients are waiting for additional pullback, and some clients are still right-sizing their exposure to tech, because believe it or not, you know, tech has been a darling for so long, and people are still holding on to some of that tech exposure. But we remain least preferred on tech, and we still think that there's more downside to tech. So we continue to advise clients to right-size that position.
This is really interesting, especially because it flies against what we've been hearing from others, including what we were hearing just from Dan Ives of Wedbush, talking about the potential for real upside in tech later this year, how much things have already been beaten up. Are you saying, Nadia, that everyone says that they're bearish on tech, but in reality, they're still all overweight and have yet to right size to where we are now and where the expectations are for earnings?
Absolutely. We have heard that from some clients. I mean, when you look at tech from a valuation standpoint, this tech sector is still not cheap. I mean, it still stays trading at a 20% premium to the broader market. And even this week, we've heard from mega cap software company, that it could take some time for that normalization of demand to happen. We saw a massive pull forward of demand in tech over the last 2 years, and they're saying that they could take 2 years for that normalization to happen. I mean, even in the semiconductor space, we're seeing some weakness here. We're hearing weakness in demand among the cloud service providers and also in data centers. So we still think that there's downside to tech. I mean, we've seen numerous layoffs. We still think that there's more to come.
Nadia, thank you. As always, Nadia Lovell there of UBS Global Wealth Management. That is the second voice in the last 20 minutes or so who's talking up, or rather talking down, earnings season. Dan Ives of Wedbush said he thinks we get the kitchen sink from the tech players at the end of this month, the start of February. Nadia Lovell is basically telling you, Tom, she thinks the lows are in our future on this S&P 500.
That's the zeitgeist out there, and again, it goes to those conference calls and the guidance forward. I would go up. The adults are telling me, look at the income statement, EBITDA, et cetera. I would go up and look at what the changed expectations are for revenues. If you get disinflation trends, even stasis, you got to believe the revenue growth comes in a little bit. It starts with that.
Lisa's on the money when she asked the question. I think a lot of people right now are saying, why take the risk? I'll take treasuries at 4 or 5%. Thank you.
I wonder how much that's a discussion, how much people have to justify equities as an asset class at a moment of such uncertainty when people can actually get income elsewhere. At what point do equities get cheap enough to offer that real offset and the potential upside? Again, I don't know how much people are talking about this, but when you talk about cash, it isn't just hiding. It's that you're getting income that might be above the dividend yield that you're getting on many stocks.
If you just landed from space and hadn't been around for a few years and heard this recession
I'd go right
conversation,
back to space.
Would you? Especially if you're listening to this show.
Correct, go on.
Anyway, and you heard the numbers, 200,000 on payrolls, unemployment with a 3 handle and wages at 5. Would it stack up, Tom, with the recession conversation? We're hearing from so many people about this year, the negativity and the pessimism around the corporation story. And I think Lisa said this, you've said it, I've said it. There's a difference between the arguments you make on the market and the arguments, Tom, you might make on the economy.
It's the heart of the matter, and we need to say it with some media humility because we don't have to publish. These people have to put something down on paper. And let me make clear, folks, what they put on paper is a lot more important than what they yammer on Bloomberg surveillance. But Nadia Lovell and the rest of them, this is tough.
Oh, super tough.
Tough.
You talked about the outlook beyond 3 months with any confidence.
If you said to me right
We've
now,
said it, try
John,
next week.
If you said this to me over a beverage of my choice right now, I would say the single idea I've heard that shows a struggle is Stuart Kaiser, Citigroup. There's just so few things to choose from. That's the feeling I get right now.
Big earnings season. JP Morgan next Friday. CPI
Next Friday?
week too, yeah.
Earnings Friday.
Busy time.
It'll work.
Bramo's disappearing. She's not going to be around for that. She's going to skip CPI. She's going to skip CPI. She's going to skip JP Morgan
Are you
earnings.
serious?
I'm deadly serious.
I was not briefed on this.
No, another vacation.
Don't tell me anything.
Another vacation. A January vacation.
My days or your days?
I think Bramo's days. Whose days are you taking?
Wait, look at the markets.
Look at those markets.
They're fascinating. Let's just talk about your boredom,
who
Tom,
takes a
with this.
vacation second week of the year?
No one. It's un-American.
Bramo does. Bramo does.
Happy New Year, guys. Happy New Year. Where's my running to shoes?
Payrolls are about 20 minutes away. This is Bloomberg.
Well deserved, Lisa. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. jobs report is out less than 20 minutes from now, and it will help determine what the Federal Reserve does next on interest rates. The estimates are that employers added fewer jobs last month. That would indicate the labor market is cooling and that higher rate hikes aren't needed. But data released Thursday show that the job market is still resilient. Republicans are making history on Capitol Hill. Party dissidents have blocked Kevin McCarthy from becoming Speaker of the House on 11 ballots. That's a post-Civil War record. The standoff has left Republicans fractured after they reclaimed the majority. McCarthy has offered concessions to hardline conservatives, but so far he hasn't been able to get enough votes. Sweeping changes on the way at the Centers for Disease Control and Prevention. That's after it faced harsh criticism for its delayed and inconsistent response to the pandemic. The CDC will require all employees to be ready to deploy to combat national health crisis, and that's a drastic shift from a fragmented volunteer system that hampered its response to COVID. The clock has started on Vladimir Putin's 36-hour ceasefire in Ukraine for the Russian Orthodox Christian holiday. Ukraine has dismissed the truce as a ploy. President Volodymyr Zelensky called it a bid by Moscow to get a break in the fighting to step up the war. And that holiday travel meltdown is prompting Southwest Airlines to revise its financial outlook. The airline canceled more than 16,000 flights over the last 11 days of the year. Southwest estimates that cost it up to $425 million in lost revenue. It expects to report a net loss for the fourth quarter. I'm Lisa Mateo. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
We think the economy is clearly slowing, but boy, we're not calling for a recession in 2023. We're still there. I don't think we're actually in the majority with that view, but the fact that the economy is holding up is part of our view there.
It's a more constructive take from Seth Carpenter, the chief global economist at Morgan Stanley, going into the payrolls report 14 minutes away. Here's the price action going into that. Your equity market shaping up as follows on the S&P 500. It is down on the week. On the session, it is negative about 0.1%. Yields are just a little bit higher by a couple of basis points at 374. The numbers we're looking for, 202,000 is the estimate in our survey for the month of December. The previous number was 263. The last 8 months, we've had upside surprise after upside surprise. Will we get another one? That's the payroll story, the headline number. Unemployment set to stay at 3.7%, according to our survey. Again, wages, 5%, Tom. Still looking for that 5 handle on wages in America.
Yeah, the wage dynamic will be important. Thanks to Tom Purcelli for weighing in on that here. And we really dive into it out here at 8:17 Wall Street and Washington time as well. We begin strong with the former governor of the Federal Reserve System, economics professor at Booth School, Chicago. Thrilled that Randy Krosner can join us each and every job say. Randy, I'm going to go Steve Levitt on you. The great Freakonomics guy, what a tour de force at Chicago Steve Levitt has had, was just to pull in the social aspect of where we are, a la Gary Becker. I want you to explain how blind we are on this jobs report, how blind we are on the American labor economy because the overlay of technology. Do we actually know a job economy when we see it, or are we just completely blind off the pandemic given modern technology?
I wouldn't want to say we're completely blind, but I don't want to go, and I also don't want to go so far to say that everything's completely unprecedented. We don't know anything, but obviously things are a little different than they typically are. We've had this historic, incredible strength in the labor market. What's been amazing is the Fed has continued to raise rates, has continued to tighten monetary policy, and the labor market hasn't cracked. We've seen the housing market start to turn down. Obviously, we've seen a lot of tumult in the both public equity markets and private equity markets. So asset prices have turned down. We've seen earnings start to come down, but we haven't seen a crack in the labor market. This is unusual. At some point, it's going to happen. And my guess is when it happens, it's going to happen quickly. Our models always say everything moves smoothly. In practice, things always seem to move a little more rapidly when they do start to turn. So some uncertainty there. But I do think at some point the labor market's going to crack.
Should your Fed use new models or rely on the old tested models? Let's go to the Phillips curve as one example, because the labor market refuses to crack.
So they are experimenting and with new ideas and thinking about, well, maybe they can have this, as we sometimes described before, this immaculate disinflation, where we just reduce the number of job openings, because that have been at record levels relative to the number of people seeking jobs. Those could potentially come down without the unemployment rate going up dramatically and the and wages start to moderate. We've never seen that before. I wouldn't put all my eggs in that basket. It's conceivable. So they're thinking about some alternatives, but I tend to be a little bit more traditional, and I think at some point the unemployment rate is going to start to go up.
Randy, do you believe in the pre-Ms review of things, that the Fed may have to go to 5.5% by June of this year in terms of a terminal Fed funds rate and hold it there for a significant amount of time in the face of the strength in the labor market that we continue to see?
Well, I've been saying this for a long time on your program, that the Fed is going to end with a 5 handle. Now, whether that's closer to 5 or closer to 6 is going to depend on the strength of the labor market, on wage inflation, on other aspects of the of economic activity and inflationary pressures. So I do think it's likely that they will end somewhere with a 5 handle, somewhere at 5 or above, and will hold it for quite some time. Now, that's the challenge, because I think the inflation rate will start to come down. But if you keep the nominal interest rate at 5%, inflation is coming down, effectively the real rate is going up. That's going to be tightening. And so I think that means that we're likely to get a significant slowdown, potentially even recession.
Which is the reason why the market doesn't believe that the Fed will actually have the gall to keep going with that, to keep it at 5% for a long time. So how would you push back against that, considering that you could wear that hat? How would you say they do when there'll be political pressure, when they'll be effectively tightening at each consecutive meeting, that they hold rates at that level if you do see disinflation and weakness?
So I think they've done a lot of the political heavy lifting already, because it's much easier to hold rates when the unemployment rate is going up than to raise rates when the unemployment rate is going up significantly. So by moving really rapidly through the last 9 months, they've gotten rates very close to 5%, pretty close to where the terminal rate is. Remember, they started out almost at 0, and now we're talking around 5. So in some sense, I think they've done a lot of the heavy political lifting already. It'll be tough, but it's much easier to just hold than it is to be raising when the unemployment rate's going up.
Randy Krauser, as you know, you've got at Chicago Jewel and Michael Weber, who really writes interesting, intriguing stuff on the social aspect of our American labor economy. And so much of his work, and frankly others at Chicago, is to say our central banks need to take a different tack. Is this a time off this jobs report today where we have to stay on traditional central bank signaling, or do we need to think about new ideas forward out of this pandemic?
Well, I think we certainly do need to think about new ideas going forward, because obviously the Fed, as well as every other central bank in the world, got it wrong. They said, oh, transitory. And that was fine for a few months, but then it was 6 months and it was 9 months that we were hearing this. And it was pretty clear after about 3 months or so that maybe we shouldn't call it so transitory. So I think, one, they need to learn the lessons from that, what could be driving inflation, understanding the supply side in more detail, and two, thinking about how they best can communicate. Now, fortunately, inflation expectations have not risen. I mean, I think that's pretty amazing, given how much inflation went up, given that they got it wrong, and other central banks got it wrong, that people didn't say, these guys don't know what they're talking about. Inflation's going crazy, and so I want 10% wage increases. They do want bigger wage increases, but inflation expectations haven't gotten out of line. So they've gotten that kind of right so far.
Hey, Randy, you're going to stick with us. Looking forward to your coverage as we break down the jobs report coming in about 7 minutes' time. Randy Croson, thank you. Mike McKee with us around the table. That makes it official, Tom. You know when Mike McKee turns up in the studio?
It's important.
You know, it's important. That's like the moment here.
But what's great about him is entourage. They come before him, so you sort of know.
They just said, I've noticed they clean the table down.
Yeah,
Dust his chair.
You noticed that too?
I feel like the field goal kicker. I've been standing over here warming up, you know.
Mike, 6 minutes away. What are you looking for?
The biggest numbers that we're going to look for is the change in service industry wages versus manufacturing goods producing wages. The Fed's been worried about service industry wages because there's a shortage of employees. So we'll see how many people get hired there and what they're getting paid and whether that is still putting upward pressure on inflation.
Do you believe in this idea that we're starting to see weakness in sort of peripheral jobs metrics aside from the official data, or is this really sort of trying to find a needle in a haystack?
I think it's trying to find the needle in a haystack. I was thinking about this morning because, you know, there's this disagreement about whether the household survey or the establishment survey are correct, and the Philadelphia Fed added some numbers up and did some calculations and thinks there's a lot fewer jobs created, at least according to the household survey. But when you look at all the rest of the anecdotal data and all of the rest of the actual data, it doesn't seem that we are seeing a whole lot of weakness. The Fed's Beige Book said that companies were finding it a little easier to find workers, but then the minutes said that companies wanted to hold on to workers. They don't want to get rid of them.
Very quickly, how much of the housing dynamic is in that important service sector data you're going to look at?
It's not as much because, of course, construction workers are all part of housing. We have seen declines in mortgage lenders, and the real estate firms, but that's not a huge component of overall. It's a much bigger deal for the CPI than it is for the jobs report.
Did you read the Beige Book?
No, with great honor.
He doesn't have any trouble sleeping.
Let me get my Tang Zero is up here, folks. With great honor to the late Richard Yamarone, always missed. I read the Orange Book.
Of course, I'm awake.
Yamarone got so angry about the Beige Book, he invented the Orange Book.
What a legend.
Yeah.
Dearly missed. Mike, you're going to stick with us.
I'll do that.
Fantastic. Thank you, sir. We're about 5 minutes away from the payrolls report in America. Going into it, equity futures are down by about 0.1% on the S&P 500. Yields are higher by 2 or 3 basis points on a 10-year, 374.41. You're familiar with the numbers now. Your median estimate for the headline number is 203,000. The payrolls report up next.
Somebody is watching and says, I want to be Ari Emanuel when I grow up. What
what should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
The payrolls report 24 seconds away. Going into it, equity futures basically unchanged, down 0.1% on the S&P 500. Bond yields bleeding just a little bit higher on a 10-year this morning. Yields up by around about 2 basis points to 3.73 on a 2-year, up by 2 or 3 basis points to 4.48. The number we're looking for, something in and around 200,000 in our survey here at Bloomberg. With the official data, here's Mike McKee.
All right, John, we're waiting for the data to drop here, and it comes in almost on forecast. 223,000 jobs created in the month of December, according to the Bureau of Labor Statistics, which is a little bit better than the 203 that was anticipated, but it is not too far off from that. Let me just see here if we have a... I don't have an immediate revision yet, but I'll get to that. Change in private payrolls up 220,000. Unemployment rate drops to 3.5% from 3.7%. That'll get their attention on Wall Street, as Jack Nicholson would say. Average hourly earnings up 0.3. That's down from 0.6. That's smaller than was anticipated. And average hourly earnings on a year-over-year basis fall to 4.6% from 5.1. Here come the revisions, 256, so a slight revision down in November from December. Again, December 223, and the unemployment rate was revised down. You don't usually see this, to 3.6% in the month of November from 3.7%. So it looks like we still have a strong labor force here. Strong labor market, jobs are being created, but average hourly earnings are dropping, and that's got to make the Fed a little bit happier. One thing interesting here, labor force participation rate ticks up to 62.3 from 62.1. So more people looking for jobs, it appears. We'll dig into that.
That's what we're trading on right now. So we've got wages coming in softer. You're seeing the participation rate come a little bit higher, and that means equities get a little bit of a lift, up by 0.5% on the S&P 500. I think you can guess where yields are. We erased some of that move at the front end. Yields were a little bit higher on a 10-year too. Now they're only up by about a basis point on a 2-year. On a 10-year, up by about a basis point as well. So another upside surprise on the headline number. But TK, it's the data elsewhere that'll get the attention of many on Wall Street. It's those softer than expected wage growth figures.
Yeah, there's no question that's the outlier here, but I go back to the gross number of unemployment rate. You're going to speak with the Secretary of Labor about this, and I'm sorry, he's standing up and down cheering. There's all there is to it.
Oh, sure. For all the gloom about recession, it's hard to make the case when we're at 3.5% on unemployment. For those out there maybe looking for something that might give you a little bit more of a leading indicator of things, Mike, what do you make of hours worked coming in just a little bit? What do you make of that?
It suggests that companies did not have to work their employees harder, maybe because they were adding workers. It doesn't make a huge change, but it does indicate a little bit less net income in the economy. Here's something interesting, though. I just saw this here. The establishment versus household. The household number goes up 717,000. So maybe what we had been seeing in the job losses on the household side is an anomaly that has now worked itself out, and the two sides will come closer together.
Mike, in honor of Professor Krosner, I took the unemployment rate, USURTOT, on the Bloomberg. I took it logarithmic on the y-axis, and the moving average cross just before the pandemic, 3.6-ish, is right where the moving average cross is right now. Have we returned to pre-pandemic labor force? I mean, when you smooth everything else, are we basically back to December of 19, January of 2020?
Well, it looks like we're getting there. 439,000 people added to the labor force, and the number of people, there were a number of people out there, and I'll give credit to Steve Stanley, who's been all over this for a very long time from Pierpont, Amherst Pierpont, the idea that the labor market's tight enough and there are enough job openings that you could see the unemployment rate continue to fall. And that is what is apparently happening right now. And this is it's an interesting conundrum for the Fed, because they're anticipating that the jobless rate should go up, so that it will reduce pressure on wages. But instead, the jobless rate falls, but the wage rate falls.
Well, right now we're at 3.5%. Mike, thank you. If you are just tuning in, 223,000, the headline number, the estimate 203, so upside surprise. A lot of people on Wall Street focused on the wage growth figure with the inflationary backdrop, the big story coming into 2023 and leaving behind 2022. Wages surprised to the downside. Unemployment at 3.5%. We were looking for 3.7. That's down from a revised figure of 3.6. The participation rate just a little bit higher. Looking at the price action, Lisa, I've got to say, not a major move. We're up by about 1/4% on the S&P 500. That's the equity market. If I turn to the bond market, yields almost where they were on a 10-year, by about a basis point, up by to 372 on a 2-year. Not really moving here at 446.
This doesn't really clarify much. There is a question of whether there is a bifurcation, and this is what I'm curious as Mike digs through the numbers, versus manufacturing versus services. Where is the weakness versus the strength coming from, and how big is that bifurcation? How does the Fed view this? Does this push them away from hiking rates more aggressively? Not clear.
Oh, right now, let's go back to Randall Krosner. He is a former Fed governor. I want to take this bigger and broader, as Mike, again, as Lisa says, massages the data. This with an equity lift in the market, bonds indeterminate right now. We have curve, a little bit of curve inversion. I don't want to oversell that. Randall Krosner, to me, this is an Elizabeth Warren jobs report. We are employing Americans. These are good numbers. We need to revisit this. Why does the Fed want unemployment? Why do they want us to have less jobs? I think that's a huge confusion for our listeners and viewers.
I think that's right, and it's an important point to make, because it's not that the Fed wants fewer jobs. What they want is lower wage growth, more because they're worried about persistent inflation. 70 to 80% of all of the costs of our production in the U.S. is related to jobs and wages, and so if that's going up really fast, that can make it very difficult for inflation to come down. Now, this is the immaculate disinflation report, that you're starting to get lowered wage growth, but lower unemployment rate, continued high growth in jobs. As I'd said before, this has never happened before, where we've been able to bring the growth of wages down and the inflation rate down without having the unemployment rate go up. This is one of those new theories we were talking about before that the Fed is putting forward. It would love to see this happen, that the wage rate growth comes down without a significant increase in the unemployment rate. This is just 1 month's number, so let's not say that we've got victory here. But it's consistent with this very optimistic view that people have, that potential, or that some people have, that maybe we could get through this without a significant recession.
Randy, let's say that this is signs of the immaculate disinflation that you talk about. And let's say we get another read like this next month and the month after. How many does it take for the Fed to adjust, given the balance of risks, that this is not actually an accurate picture and that inflation is still strong and that the labor market is too strong for the Fed's wishes?
So they're certainly going to continue to buy insurance. They're not going to say, oh, the inflation, wage inflation is coming down, just like overall inflation is coming down, we're done. They're not going to say that at all. They're certainly going to continue to raise rates at the end of this month, likely continue to do that in March. but it may make it more likely that they go 25 basis points rather than 50 basis points at these meetings. I think that's really where it's going to be. But they're still going to be buying some inflation because they know that this is sort of a new and untested hypothesis. Maybe it'll work, but they're not going to take the risk that, declare victory, and then the wage rates start to go up, inflation rates start to go up, and then they've really got to move in interest rates up because they worry about losing credibility.
Hey, Randy, thank you. Just wonderful coverage from you, as always. Lucky to catch up with Randy Krosner there of the University of Chicago and, of course, formerly of the Federal Reserve. Mike McKee, we hear from Chairman Powell next Tuesday, don't we? Next week.
I believe so.
And yeah, it's going to be interesting to see what he says about this.
I think it'll be a little bit longer than 8 minutes. I think the interesting thing here is that you got the tension between the low unemployment rate and the wage rates. And as our old friend Bob Cinch, the former goalie for the surveillance hockey team, points out, there was a big revision down in average hourly earnings on a month-to-month basis. It went from 0.6 to 0.4 in November. So it did fall again, but it just shows that wage pressures seem to be easing at a time when the unemployment rate is falling, which is kind of not what you'd expect. So this raises the debate, and you guys out there on the trading desk can answer it, 25 or 50. You know.
Well, that's dependent on CPI next week, I guess, Bramo.
Well, we just heard from Randy Krosner that this labor market report increased the chance that the Fed would go 25 basis points at a number of consecutive meetings, moving away from 50 basis point rate hikes. I thought that was fascinating because in the balance of risks, they want to buy insurance, in his words, against going too far if there is this immaculate disinflation.
The curve steepening just a little bit. The 10-year now up by 3 basis points. The 2-year not doing much. Equity futures on the S&P 500 up by 0.4%. One of those payrolls reports where I think a lot of people are still working out what to do with this. Coming up in the next hour, Rick Reeder of BlackRock, Anastasia Amoroso of iCapital, Mike Collins of PGIM, then plus Labour Secretary Marty Walsh at 9:45 Eastern
time. I want
time.
to really hear from Michael Collins there. That's the guy I want to hear from today. Mike, that's great that you've got.
I want to hear from all of them. I think it's a great.
Thanks for that, Lisa.
No, but I really
Trying to give Secretary Walsh some love as well.
It's going to be fascinating to hear the administration's response.
But the bond guys, their heads got to be spinning.
Without a doubt, without a doubt. I'm going to run before you offend anyone else.
Would you like some shoes? I recommend sprinting that way.
No, I think it's just it's conundrum. Did you say the word, Michael, conundrum? I think that's where we are.
Yeah. It's a different conundrum, though. This isn't Greenspan's conundrum. This is, well, it's Jay's conundrum.
Futures up 15. The VIX comes in ever so slightly off yesterday's trauma, 22.11. Right now, Jeff Rosenberg joins us, portfolio manager of the Conundrum Fund at BlackRock. We're thrilled he could join us this morning. Jeff, I want to ask you the question I was going to ask Professor Krosner, but instead I'll go to Professor Jeff Rosenberg, and that is, can you substitute a duration or a stasis in Fed policy for going up to a higher rate? Can you actually get away with that shell game?
You know, it depends on what we're looking at today in the data and what it implies about inflation. Today's about, wage inflation, and, can the Fed get away with a pause is really about whether they're making good on the inflation trajectory as the market is expecting it to decline. So they'll pause if inflation is declining, but they won't be able to if they're not achieving their inflation objectives. I just want to comment a second on the report is mixed between the unemployment rate and the wages. As we have seen for a number of reports, the payroll report has really become kind of the stepchild of economic reports relative to next week's CPI. So what's really important here is what can we look through into this report as to what it says about inflation. And obviously the headline on that is average hourly earnings, and that's a little bit positive. But what I want to highlight out of this report is something we haven't talked about yet. The big expectations in inflation is that you have this persistent expectation that goods deflation is going to support the consensus expectation for declining inflation. The one thing out of today's payroll report I think that's interesting to highlight is that if you look at the goods components, wholesale trade, retail, transportation, those are up total 26K in terms of the monthly payroll gains. That's a significant change relative to the pace of about a 3-month average of -4, 6-month average of around 6. And if you look through and you squint a little bit, it is worth noting that this is a little bit of a different story, that we've had an expectation that the good side is deflating. If you look into today's payroll report, it tells you a little bit of a different story, that maybe you're seeing some signs of life in the goods. If we see that into next week's CPI report, that's going to be a big change relative to market expectations. I think that's one of the interesting takeaways from today's payroll report.
People don't do nuance well, Jeff, especially after living under the Fed's thumb for so long in terms of don't fight the Fed. So there is a question of, as you parse through the nuances of this data, what do you do? How does it shift what you actually do in the markets, what you buy, what your thesis is for 2023?
Yeah, well, this is the thesis for the market consensus thesis, is that goods deflation is supporting the peak inflation expectations. That supports the Fed pause and really feeds into the market, the bond market expectation that the Fed can pivot. So you have the tension is really on the services inflation. Today on the headline, you get a little bit of support for that because you see average hourly earnings coming down. But this is still a strong labor report. It's still a strong labor market, and we are not yet seeing a significant tightening in labor markets from the significant tightening in interest rates. That may be lags, but it may also point to a lack of interest rate sensitivity in the broader economy outside obvious candidates like real estate.
I'm looking right now at the market reaction, and as market participants parse through this, you could see yields significantly lower on the front end. This, to me, is interesting, down to 4.4%. It's something to write home about, considering some of the volatility we've seen. But would you lean against this, Jeff? Would you actually say that this labor market report is nothing particularly shocking in order to go against what people think in terms of a hawkish Fed, and that they're going to hold rates at 5% for much longer than currently priced into markets?
I think you can't read too much into today's report. As I said, it's mixed. It's got a little bit of everything, or a little bit of something for every point of view. And then I think if you stare really closely at some of the data, there is a suggestion here that this consensus view on the good side, may be undermined a little bit. I wouldn't read too much into that, and I think the kind of mixed message is reflective in a relatively muted bond market reaction to the report so far.
If you're joining us on radio and television, Jeffrey Rosenberg with us with BlackRock. We continue here with a nice lift to the markets. Futures up 29, Dow futures up 247. The VIX comes in nicely, so it is a better equity market off the report. A bit of disinversion in the 2-10 spread. We are on negative 76 basis points, a less inversion here seen by the report. Michael McKee calls it a conundrum. Jeff Rosenberg, how do you allocate here? The hallmark of what we've seen the last 2 days in surveillance and conversation is everyone extending out their view. It doesn't matter which shop, sell side, buy side, everybody is reaching out. How do you allocate a portfolio given all this uncertainty right now, where the safety may be just to take a stasis bet, not a dynamic bet out into 2023?
Yeah, there's a lot of sort of false changing in positions that associated with, year ahead outlooks and the turn in the calendar. We haven't really changed much in terms of the narrative from where we left off at the end of last year. This is a market that is split between kind of soft landing and hard landing scenarios. But where the consensus expectation around declining inflation, leads the ability for the Fed to pivot. And what's interesting and what we saw, in the minutes earlier this week is the tension that creates with this financial conditions component of monetary policy transmission. That is, the Fed wanting to push back on markets getting too far ahead of a Fed pivot. And I think that means for portfolio positioning, you've got to take what the market gives you. And I think you've got to be pretty cautious going into that uncertainty. What the market's giving you right now in the fixed income market is an inverted yield curve. Your best yields are found with the least amount of risk. And I think that's what you've got to take here until some of the clarity around hard, soft landing, consensus views around inflation being realized start to get validated in the data.
Jeffrey Rosenberg, thank you so much. With BlackRock this morning, the Bloomberg Financial Conditions Index, I'm watching my number one statistic, a negative 0.20 standard deviations. If that's Greek to you, all you need to know is it's going away from where Chairman Powell wants to be to an accommodative state. We accommodate now with Ira Jersey, Chief U.S. Interest Rate Strategist strategist for Bloomberg Intelligence. Ira, what does this report validate? I'm going to call this a good report. McKee may say I'm wrong, but what does this good report do to validate your outlook for 2023?
Yeah, well, I do think that it's showing that we're seeing at least a little bit of moderation in that labor income growth. And when I look at aggregate labor income, I look at the total number of jobs times the weekly earnings, and weekly earnings, that's fallen quite significantly. So that was over 7% last month. It's now just a little over 6% now on a year-on-year basis. And as long as that keeps coming down, that means that the Fed is probably nearing the end of its interest rate hike. So we put out in our monthly just a couple of days ago that we thought that the Fed was only going to go 25 basis points this month because, in my view, they're in calibration mode. And that means that we've probably seen the peak in most yields for this cycle so far. So again, a continuation of this trend, and I think that the Fed's going to be pretty happy, actually.
Ira, this is really interesting to me. In other words, you think that we've seen peak yields across the curve, even on the front end, despite the fact that increasing number of people are saying that perhaps the Fed's going to have to shock this market into cooperating with the tightness that it's desiring.
Well, so it really depends. When you look at the very front end, when I say peak yields, I really am talking about twos and further out the curve. But even if the Fed goes to say 5.5%, then fair value for 2-year yields is actually only about 4.6%. So it's not that crazy, particularly since the higher the Fed goes, the more likely the market's going to price for just deeper cuts in the either very late this year and certainly into 2024. So as we get the Fed pushing against the slowing economy, we're going to just see a deeper expectations for deeper cuts, and that's going to keep most of the yield curve, if not as inverted as it was, certainly yields that are at these levels or maybe even a lot lower.
I just am struggling with this idea that we got an above expectation on the headline number. There are signs of reinflation in certain goods sectors. There are signs that there still is resilience, that would be enough, Ira, for this Federal Reserve to back away and allow things to rip. Do you think that that is plausible despite the rhetoric?
Well, I don't think things are going to rip at this point because the Fed has hiked quite a lot, right? Like someone said yesterday when they looked at SOFR futures and we're like, oh my God, those rates are so high. Now they're only so high vis-a-vis the last decade. They're not high, given the our careers and how high interest rates were prior to the financial crisis. But the Fed, I think, is in calibration mode. So even if they only hike 25 basis points in January, that doesn't mean that they can't go to 6%. It just might take them another 6 weeks or 3 months in order to get there. So really they're trying to calibrate because, Jay Powell has mentioned and a lot of members have mentioned they don't want to hike too much. But the problem is that they don't know where the final number should really be in order for an equilibrium in the economy. And Tom, as you pointed out, financial conditions, if you go to FCON Go on your Bloomberg terminal, you'll see that financial conditions have eased, but they're also have eased from the last couple of months. But they're still much, much tighter than they were, say, at the beginning of 2021.
All right, Jersey, we look forward. Bloomberg Intelligence Fixed Income Publishing after the jobs report. That'll be out on the Bloomberg terminal here in a bit. He sits here, Lisa, you bring him in because I'm in the glow of watching McKee do the McKee magic.
Well, this is actually the most interesting part.
He has secret spreadsheets. Even Marty Walsh doesn't have the spreadsheets that Mike McKee
They glow,
has.
they bring you in, they have pictures. This is, before we get to Mike, I do want to just give you a sense that the NASDAQ right now is at more than 1% in pre-market trading. You could see yields substantially lower, notably lower. This is a market that is embracing the idea we heard from Randy Krasner, which is the immaculate disinflation. Are we seeing that? And this idea that the Fed could downshift to 25 basis points at its next meeting. Mike, you've been looking through all of the details of the report. What is the divergence between services, between manufacturing? What does the underlying belly of this report tell you?
Well, give me 2 seconds here. I was just plugging in the numbers for the wage changes. And services wages actually came in lower than the increase in goods producing wages.
There you go.
Goods producing were up 0.4 last month, and it was only a 0.3 gain for services producing. So maybe what we're seeing is a kind of return to, as Tom said much earlier, pre-pandemic trends.
Is there anything seasonally that could have something to do with this in terms of people not getting as many new jobs in this latest report or changing or anything like that? Or is this just really a clean read?
Well, we know the seasonals have been kind of screwed up by the pandemic, and hiring has changed a lot. We did see retail jobs added this month, but they were subtracted in November, and that's not usually what happens. So, yeah, there could be some aspects to that. I noticed that there's no real category that just jumps out at you with a lot of jobs. Leisure and hospitality, 67,000. Yeah, we've been anticipating that. Manufacturing, 28,000. Construction, still 8,000. So even though housing is rolling over, now the mortgage brokers lost 7,500. And then here's my interesting stat of the day for you. Federal government employment rose by only 1,000. And we know there are 434 people in Washington who at this point are not getting a paycheck.
Are they in the statistics?
They haven't been sworn in yet.
McKee looking for the McCarthy angle. Michael McKee, thank you. And he'll dive into this. You'll hear from Michael McKee on radio and television here through the morning on this important jobs report. We look at the ultimate conundrum, which is picking up the pieces of an equity market to forget in 2022. Making her first appearance on Bloomberg Surveillance, or people have allowed her to come on before earnings season. Gina Martin-Adams joins us, Chief Equity Strategist for Bloomberg Intelligence. Gina, I don't want to go economics on you right now. I want to go on what your team is thinking about into earnings season. What is their number one mystery?
You know, I think the number one mystery is where is the margin growth going to come from later into 2023? When we look at the consensus expectation, consensus has gone a long way to pricing an earnings recession. Certainly earnings have been falling ex energy all year in 2022. Earnings are now expected by the consensus to fall for 3 consecutive quarters overall for the S&P 500. So the consensus is getting significantly more bearish, consistent with the economic trends. But where they're getting a little bit more optimistic is in the idea that we are in the midst of forming our margin low on the index. If that is indeed the case, we're likely to see earnings improve materially into 2024. And it's a bit of a conundrum as to where that's going to come from. The consensus right now thinks a lot of that comes from tech, suddenly showing some degree of improvement in the revenue lines as of the first quarter. Where is that earnings growth going to come from in an environment where business investment is contracting now? So I think we've got, companies are going to have a lot of questions to answer in the upcoming weeks.
Gina, there's also a question about what the impact of a slower pace of rate hikes will have on specific industries that have thought to be very interest rate sensitive. I'm thinking of big tech. You're seeing NASDAQ get a pop today. How long does this story make sense to you, where if the Fed doesn't become as restrictive as some people think, that it will become a wholehearted positive for the tech sector?
Yeah, I think there's a lot of conflicting sort of wins with respect to tech, Lisa. So first, our view would be that tech hasn't even priced in the rate hikes that we've had, let alone the rate hikes yet to come. When we look at high duration or long duration stocks relative to short duration, low duration stocks, we see still a tremendous gap there where tech is a high duration sector, the highest duration sector indeed in the S&P 500, still trading at a standard deviation above its long-term average premium to the S&P. That really flies in the face of what we're seeing with rates currently. So that's one thing to consider. The other thing to consider is that tech is the earnings laggard in the S&P 500 and is experiencing the most negative pace of earnings estimate revision right now. So until those two things sort of square off in a much better condition, I think it's going to be really difficult for tech to perform well, even if the Fed pauses. If tech is still the earnings laggard, there's not a big case to get excited about tech.
Gina, you got 45 seconds. You have a wonderful portfolio launched 2 months ago with Bloomberg Intelligence. How much did it tank in the last 60 days of the year, and how are you going to pick up the pieces on your portfolio in 2023?
You know, the MVP portfolio is actually has done relatively well because it is a value-oriented portfolio with a focus on profitability as well as momentum. It has very little energy exposure at the moment. Energy has been a really tough place to be over the last couple of months, and it has very little tech exposure as well. So it's sort of, it's been invested in an area of the market that gets a little bit less attention, frankly, but also is less volatile, more profitable, and has significant value. It's generally designed to be a longer-term portfolio, so a 2 months time horizon is a little bit rough for a benchmark, but nonetheless, it's done quite well.
Oh, come on, that's long-term in your world. Gina Martin Adams, thank you so much with Bloomberg Intelligence. I'm going to tout this all year, folks. You're going to hate me for it. They've got a really smart, whether you agree with it or not, doesn't matter. It's great to study the Bloomberg Intelligence MVP portfolio just as a study on value at this time. Lisa, I was making a joke about this earlier. I don't think we got the banner up on this being the Elizabeth Warren jobs report. I'm sorry, it's a pretty good report. How does Chairman Powell react to the Senator Warren jobs report?
It's going to be interesting because they don't want to signal the all clear sign for fear of getting ahead of themselves, of allowing markets to get ahead of what they want the policy to be. They're looking at an unemployment rate that rivals the lows that we have seen going back to the late 1960s. They are talking about the idea that even amid this strength, we're seeing that disinflation, the fact that wages are not increasing as quickly as possible. How many more of these do we need to see before people can start getting more optimistic about some sort of more healthy and normal labor market?
I will say Alan Greenspan codified the word conundrum that Mr. McKee used today, and that's where we are. Conundrum is green on the screen, up a solid 1.1%. Standard & Poor's futures up 45, Dow up 367 points. The VIX 21.78 comes in smartly, a better statistic, less fear on the VIX. Please stay with us through the day. Really going to be interesting. On radio, on television, this is Bloomberg Surveillance.
Live from New York City this morning. Good morning, good morning. Payrolls beat again, and this market's rallying hard, up 1% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue. Payrolls beat again. The jobs report delivers another upside surprise. Wage gains slow more than anticipated, and investors wait for Chair Powell's take.
Payrolls.
Non-farm payrolls.
What can we look through into this report as to what it says about inflation?
It's still a very interesting labor market.
The labor market is strong.
It's tough from the Fed's point of view.
We have a tight labor market.
The tightness in the labor market is a key concern for them and why they continue to raise interest rates.
They're worried about persistent inflation.
We have around 10.5 million job openings and around 6 million unemployed.
It's not that the Fed wants fewer jobs. What they want is lower wage growth.
It comes down to the economic data.
Today's about, wage inflation.
Joining us now to break it down is Mike McKee. Mike McKee, equities up, yields down. Can we whisper Goldilocks this morning?
Yeah, I think you can whisper it. We'll see if it turns out to be just right, but it is going in the right direction for the Federal Reserve because not only do we see inflationary pressures easing a little bit, we see still strength in the labor market and the economy. Jobs come in stronger than expected, 223, and only a very small revision to prior months of about 28,000 lower, 256,000 last month. So still a very strong labor market. Private payrolls up to 20. The unemployment rate is a big surprise. 3.5% from 3.6%, a revision down to the prior month. And some of this may have to do with the household surveys annual revisions, but it is still good news. We saw a big jump in household hiring, 717,000 during the month. Average hourly earnings, and this is where the Fed comes in, on a month-over-month basis, up just 0.3. Initially reported as 0.6 last month. That was revised down to 0.4, so less wage pressure. And on a year-over-year basis, it puts us at 4.6% compared to 5.1% initially reported last time. And you can see we're coming down towards that zone that the Fed is looking for in terms of the average hourly earnings. So we're seeing it drop. That doesn't show the 0.3 move this time, but it does show you where the green lines are. The Fed wants the number to be. And then in terms of the household survey, this is interesting because, again, we did see annual revisions, but we're seeing the civilian labor force rise by 439,000 during the month. So people coming off the sidelines, that pushed up the labor force participation rate to 62.3%. And as I mentioned, 717,000 people come off the sidelines and into jobs in that household survey. There's been a big question about why household, as you can see there, was running so far below establishment. We made up some of that ground today, John.
Hey, Mike, what do you expect from Chairman Powell next week?
Well, it's probably interesting because he doesn't want to go too far one way or another and lead the markets away from where they have been. They don't want easier financial conditions, but it does suggest 25 basis points is probably all they need at the next meeting. The question is, do they think they need to do 50, get it out of the way? But I would think he would be, on a relative scale, dovish. I'm not sure how much meaning dovish and hawkish have these days, but on a relative scale.
Mike McKee, we appreciate it. We'll catch you with Mike a little bit later. Joining us now, I'm pleased to say, is Rick Reeder of BlackRock. Rick, your challenge, your first one at least, is to make sense of this. Surprise to the upside on the headline number. Wages come in softer. Unemployment drops to 3.5%. Can you square that circle for us?
So, by the way, I think there's another stat that's also relevant. Temporary hiring is down for the third straight month. Is negative. I think it was negative 35,000 again. So you're clearly seeing an economy that's moderating, and obviously you see that play through on the wage side. But John, I'm going to go back to something we've talked about the last couple of months. People have been talking about a deep recession. I mean, when you actually put these numbers together and you think about, we talk about, why the world thinks soft landing is so elusive. If you're still hiring a good number of people, particularly in the service sector, leisure, hospitality, healthcare, education. By the way, they're lower wage jobs generally. Part of why you're seeing this earnings come off of it. But boy, all the indications are of economy slowly moderating, inflation coming down, which we're pretty confident in inflation. I think we're going to see that next week in the CPI data. So it's good. Is it still an economy that's pretty vibrant? I still think it is. I mean, when you cut through the data, you're still hiring a lot of people, and the service sector is still behind pre-COVID in terms of where they need to get to in terms of, you see this in healthcare particularly. And so that's buoying what is still good consumption in the economy generally, with some slowing. Pretty good data for if you're the Federal Reserve.
Well, this market's picking up on that. The equity market's rallying 25 minutes away from the opening, down up more than 1% on the S&P. We've got this bull steepener in the bond market. That's some jargon for you. Just a rally at the front end. The 2-year rallying harder than the rally that you see on the 10-year. The yield is lower there by 7 or 8 basis points on a 2-year. The 10-year's down by about 5 basis points. Rick, I've got to say this. Coming into 2023, you were more constructive, dare I say, optimistic than most about the ability of this Fed to engineer that soft landing. Can you tell me what you think that landing's going to look like?
So, John, I still think you have to consider, first of all, you've got to consider what's going to happen in the rest of the world, i.e. what's going to happen with China, and what our sense is that China's reopening and see better growth there. But boy, when you break down the data and you look at it and you say, gosh, where are the sectors that are interest rate sensitive? Housing, real estate, commercial real estate, pressure there. You'll see more pressure there. The auto sector, if you look at some of the auto stocks, not just the high profile Tesla, how they've reacted the last couple of months, interest sensitive, financing levered, those are going to be tougher. But then you look at parts of, we saw this in some of the earnings like Costco, et cetera. Then you see other parts of the economy. Consumption is still pretty good. You see that in apparel. You see that in other parts, certainly see in sporting goods, leisure. So listen, I think it's an economy that you're still going to, my sense is nominal GDP next year can still be above 3%, buoyed by inflation, and maybe you get into the 4s. It's not terrible data. Again, but it's a divergent economy. The interest-sensitive parts of the economy, like real estate, and since the last time we were on a month ago, Jonathan, you see the pressure you're in certainly commercial real estate, and that should continue.
$1 trillion question. Does your cash position now reflect your optimism?
Yeah, so in a certain way, and we talked about it last month on the show, we've let our cash run down a fair amount. I have to believe in this scenario. So think about where we were a couple of months ago or a few months ago. We were talking about Fed moving 75 basis points, 4 subsequent moves. Now we're debating, are they going to go 25s, a couple more? Maybe, by the way, you can't write off another 50, but are they going to go another 25 or so? The volatility of the risk-free rate is coming down quite a bit. What does that mean? Fixed income, I think, is going to have a pretty good year. Listen, I still think you got a Fed that's going to keep moving, but fixed income, when you finish 2023, I think it's going to have a pretty good year. You can get yielding assets where the front end is now, where the whole curve is. You can buy quality assets and get yourself, we talked about this last couple of months on the show, you can get yourself a 6 in many places in terms of your carry, in terms of your income. And by the way, not stretching to do high yield, not stretching to do a lot of emerging markets. That is nirvana for fixed income. I think rate volatility is coming down. You see that playing out big time in the market today. And that, things like agency mortgages that were not a buy for a long time, you can get some real quality liquid assets at real yields. And so I'm pretty comfortable with fixed income. Listen, I think the equity market's not that interesting because of the earnings pressure and margin compression. But gosh, to get some income in a portfolio, it's a very different scenario than we were a few months ago.
Well, let's get to the essence of what you're saying. I think it's a different scenario, never mind the last few months, the last 10 years. It's just a massive change, Rick. Can you just walk me through how much additional risk you have to take to get that kind of yield? You touched on it briefly there. Can you just build on that, Rick? Because you said not high yield. Is it investment grade? Just give me a little bit more detail, the sectors, the quality.
Yes, sir. So first of all, the 10-year average, we go back 10 years, the 10-year average of the 1 to 3 year part of the aggregate index, the index is, I think the average is 1.18%. Now that index is about 4.5. So meaning you don't have to go out the yield curve, you don't have to go down into high yield, and you're getting a 4.5 just by sitting in 2-year things like investment grade credit, things like AAA securitized assets. And then, you take a little bit more risk, you go a little bit further out the curve, you can get yourself close to a 6. So do I like investment grade credit? I do. By the way, not just in the U.S., in Europe, because of currency, you could swap it back to dollars. So I like investment grade. Agency mortgages are a whole lot more interesting this year than they were last year. AAA securitized. This is a boon for fixed income investors, and you don't have to take nearly as much risk as we had in the past. Think about where we were 2 years ago. You had to buy high yield at 3.5% to get yield in the portfolio. Now you don't have to take much risk and create a really nice income producing portfolio.
Rick, something you and I have explored over the last number of months, particularly ended 22 and coming into 23. Do you get the sense this is a moment in time, just a big opportunity in the short term? Or do you get the sense this is the new normal, dare I say, the old normal for fixed income?
Oh, that's a great question. So, Jonathan, I think you got a Fed. I don't think we're going to the Fed's going to start cutting rates. I don't think they're going to start cutting rates this year. I don't think it's a big rate rally in fixed income. I don't think this is like the salad days of, gosh, rates are coming down. I think this is a very exciting time in terms of just build income and carry well. Listen, I don't think you write off. While I'm enthusiastic that I think the soft landing is easier than people think, listen, you still have to build in. We still have a war going on. We still can't solve the Speaker of the House. We were still not certain on how China's going to develop. But if you can build income and, finish the year with a mid to high single-digit return without taking a lot of risk, that's pretty good. That's a pretty good environment. So this is different. But inflation is coming down, Jonathan, but I still think we're going to be at these rates for a period of time. So, listen, I don't think this is, one of those years we have this explosive fixed income rally. I just think it's clip the coupon and maybe around the edges you can generate relative value returns, find some areas to pick up incremental return and try and throw off.
Rick, when you say
high single digit,
we might have to live with this for a while, what kind of numbers are you thinking about? Because the Fed chair, officials at the Fed, they come out and they tell us they're going to go to 5, maybe north of that, 540 if you're Neil Kashkari, and then they're going to pause. And Rick, I hear so many people that just don't believe them. They think that they're going to pause, and the pause is a signal to ultimately cut soon after.
So, listen, I don't think you can write off that the Fed's got to go. That will go to 5.25. By the way, I don't think you can write off they can go to they'll go to 5.5. The data has to support heretofore. I mean, this is a pretty good number certainly in terms of wages. We think the CPI report, if you get a decent CPI report, you're talking about 3 straight months of core CPI with a 0.2 handle month to month. That's pretty good. And so, but we got to see the data. And in the interim, when you print 223,000 jobs, you still have a strong labor report. You still have a strong labor market. So you've got to assume the Fed's got some room to go a bit more. This is part of why I'm not in, gosh, let's jump on board. The rate market is going to rally. I think you still have to be conservative in the position. The nice thing is your carry is so powerful today just by holding these assets, and particularly in the front end, that you can absorb the, if rates do move up. And so you look at your portfolio, it's 3 months, 6 months, 12 months hence, even if the Fed, like you say, which I don't think you should discount, even if the Fed does go to 5.25, 5.5, or as Kashkari was saying, 5.40, you still end up with a decent return. And by the way, that's very different than we've seen in the past when rates are at zero and you had to have a scalpel to figure out surgically how you're going to generate a couple of basis points of return without losing total return of your portfolio.
Rick, can we finish with the risk management question for the Federal Reserve? This is something they're exploring, we're all exploring. In the minutes, they talked about managing these two risks, and I'll share them with you verbatim from the minutes. One risk was that an insufficiently restrictive monetary policy could cause inflation to remain above the committee's target. That's risk one. Risk two, it's complete opposite. The other risk was that the lagged cumulative effect of policy tightening could end up being more restrictive than is necessary. If you were coming into 23, what do you think is the bigger risk, the more important risk for this Fed right now?
So, to me, it's very clear. I mean, if I were the Fed, listen, I think you can't write off they're going to go to 5.25, 5.5, because I think they're very concerned of being the Fed that paused too early, and there was the Arthur Burns type of phenomena. So what do you do with that? What is the bigger risk? The bigger risk is that they over-tighten. And we talked about a divergent economy. You bludgeon the real estate market, you bludgeon the interest-sensitive parts of the economy, like the auto sector. And that is, I think, the bigger risk today. I think, if it were me, I wouldn't. I think if you get to 5, you can leave it there for a while. But that being said, I think you have to take this Fed at its word that if they don't see improvement and persistent improvement, they can go a bit further. I don't think they need to, but and I think you will hit the interest-sensitive parts of the economy, which is, you think about, this is not the 80s economy that was a goods-oriented economy. It's service-oriented, a huge portion of the economy. We see this today in healthcare, education, et cetera, which hires huge amounts of people. It's not as interest-sensitive. The problem you create is you create a two-stage type of economy. You really hurt part of it, and the other part's not really seeing the effect. That, to me, is we don't need to get there, and so this is part of why I think the Fed, can pause at 5. Although, like I say, I think you should assume that they may go a bit further.
Rick, final one from me. I think you and I have talked about this before. Can you just tell us how busy you are relative to previous Januaries and years gone by? In fact, in decades gone by, how much busier are you this time around?
I don't know. Always busy. Jonathan, this is, you're trying to get, it's an interesting dynamic of how markets work. You think about December and it's, people figure out, how they want to take some time. And then you come in this year and boy, it's like everything, you got to put everything into place. So I don't know if it's busier than any other time, but I think a divergent economy, and you think about the stock market, some of the market is too high.
Yeah.
But there are some opportunities. Some of the stuff's gotten torched in the last. So anyway, I'm pretty enthusiastic, pretty excited about, unfortunately, weekends are pretty jammed because there are so many cool things to look at across these markets in a divergent world. And that's what I think will typify 2023 is find the divergence and find the opportunities.
Well, for now at least, people lining up to buy your asset class. And that's a major change. Rick, this was awesome. Happy New Year, buddy.
Thanks.
To you and the team. Great to catch up. Looking forward to doing this through the rest of this year as well. If you are just tuning in, where have you been? 45 minutes ago, payroll surprise to the upside. Wages come in softer. Unemployment comes down to 3.5%. And equities rally by 0.9% on the S&P. Yields lower at the front end. We're down 7 basis points on a 2-year to 4.39. Coming up, a mixed jobs report offering a little something for everyone.
I think you can't read too much into today's report. As I said, it's mixed. It's got a little bit of everything, or a little bit of something for every point of view.
Anastasia Amoroso, Mike Collins, coming up next.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one, and through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
I think you can't read too much into today's report. As I said, it's mixed. It's got a little bit of everything, or a little bit of something for every point of view. And then I think if you stare really closely at some of the data, there is a suggestion here that this consensus view on the good side, may be undermined a little bit. I wouldn't read too much into that, and I think the kind of mixed message is reflective in a relatively muted bond market reaction.
Something for everyone. That's the take from BlackRock's Jeff Rosenberg. Another month of strong job growth, showcasing the economy's resilience as wages cool. Former Fed Governor Randy Krozen is saying maybe we can even skirt recession.
This is the immaculate disinflation report. This has never happened before, where we've been able to bring the growth of wages down and the inflation rate down without having the unemployment rate go up. This is just 1 month's number, so let's not say that we've got victory here. But it's consistent with this very optimistic view that people have, that maybe we could get through this without a significant recession.
Joining us now, going into the opening bell, iCapital's Anastasia Amoroso, PGIM's Mike Collins with us as well. Happy New Year to you both. We're going to start with the data, then we'll shift to the market around the open. But Anastasia, first to you. Is this what Randy called just then the immaculate disinflation jobs report?
Well, good to see you, John. I do think this has the signs of being a soft landing report, and I like it. I think it's constructive for the Fed, and I think the markets are interpreting it as such as well. What I like about this report, first of all, we're still creating net new jobs. Jobs are a good thing. We want people to have jobs in the economy, and I don't even think the Fed wants people to see, massive job losses. That's not what they're after. But the second thing that I like in this report, and the Fed is likely like, is the fact that wage inflation is starting to ease from 5.6% about 9 months ago to 4.6% today. That's exactly what they're after. And the reason why we're seeing this easing is even though there's this rebalancing going on and loosening in the labor market, what's happening is the sentiment around layoffs, I think, is impacting how employers think about the wages that they're willing to offer and how employees are thinking about that. And the fact is both are willing to offer and accept less. And that's what creates a little bit of this downside wage pressure. So that's great news. And then all in, the Fed is likely to look at this and say, look, our medicine is working. We're going to continue to keep the equity market anchored, the economy anchored at below potential GDP growth, and that should result in the rebalancing in the labor market. So to me, this is a soft landing report.
Mike Collins, is this the real deal or a head fake?
Jonathan, this disinflation or moderation inflation really shouldn't be that surprising. I think this whole COVID recovery has been so confusing to analyze because you had such an overshoot in prices of everything, of commodities, of food, of wages, of rents, and they're all coming back down to kind of more normal levels here. So I think the real story was how everything overshot. Last spring, 9 months ago, was really the peak in wage growth. Wage growth is down 100 basis points from kind of 5.6 to 4.6 now. Food prices are down 15% since then. We all know about the commodity complex. So rents are rolling over. So I think this whole kind of disinflationary trend is just going back to lower inflation. The question is, does it get back to 2 or does it stop at 3 or 3.5? And And I do worry that it kind of stalls out at 3 here.
And what kind of GDP price do we need to pay in the meantime, Mike? How big is that going to be?
You know, I don't know if you have to pay a big price. I think a 5% funds rate for half a year or a year so far hasn't been that tough. But I think the longer, I know you like to talk about the pause versus the pivot, the longer the Fed keeps those rates in really restrictive territory, and anything with a 4 handle, never mind a 5 handle, is really restrictive. And remember, the balance sheet is tightening every day. $1 trillion a year will roll off. I don't know what that's equivalent to in rate hikes. Call it another 50 or so. That's really tight financial conditions. The longer that lasts, Jonathan, the longer it starts to bite lower income individuals, more leveraged capital structures, other asset prices like private debt and real estate, which haven't really corrected yet. So I do think at some point the Fed will have to recalibrate and get that rate back to a normal level, like 2.5 or 3.
We'll discuss that in a moment and what it means for this market. We get lucky this morning with the both of you. Thanks for being with us. Mike Collins, Anastasia, going to be sticking with us. Coming up, the morning calls, and later we get the view from Washington, D.C. We'll catch up with the Secretary of the Labour Department, Marty Walsh, reacting to the payrolls report. We'll catch up with Anne-Marie down in Washington as well. Equity futures up 0.8%. The opening bell, 7 minutes away.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
About 4 minutes away from the opening bell. Yields down, stocks up. Following the payrolls report, wage growth coming in a little bit softer. The headline beat, you saw that on payrolls. Equities up 0.8%. Let's get you some morning calls. First up, Stifel upgrading MGM Resorts to buy, expecting shares to benefit as Macau Vegas casinos reopen. Wells upgrading Lulu to overweight, recommending high-quality defensive recovery plays given the challenging backdrop. And finally, Deutsche Bank downgrading JP Morgan to hold, highlighting numerous downside risks, including a potential U.S. recession and peaking earnings. Coming up, big bank earnings just 1 week away. That conversation coming up next, plus the view from D.C. with Secretary Walsh.
thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close. Welcome to Bloomberg Crypto.
I believe that is the 9th consecutive month that payrolls have beaten estimates on the day. Got another one. This time, though, it came with softer wage growth, and that's why you're seeing this rally this morning. S&P 500 futures up 0.9%. On the Nasdaq 100 up 6 or 0.7%. The small caps, the Russell, up about 1%. There's the opening bow switch at the board and get to the bond market. Stocks up, yields down by a basis point on a 10-year, much more so at the front end. 370.66 is where we are on a 10-year at the moment. Euro dollar not doing much, 105.20. Had some CPI data out of the Eurozone a little bit earlier this morning. Core inflation still sticky. Headline comes in. The ECB with work to do. In the commodity market, crude up by 1.6%, $74 and about 90 cents. I think we can call that 75. About 20 seconds into this session, I'll bring you the opening prices on the S&P and on the Nasdaq too. On the S&P 500 up by 0.7%. On the Nasdaq up by 0.5%. One stock to watch around the open, I think you can guess, is Tesla. The EV maker announcing another round of price cuts in China. That stock, Abby, getting hammered.
It really is. It's getting destroyed over the last couple of weeks and really the last year. We'll be taking a look at that in a moment. But more bad news out of China. The second round of price cuts in about 10 weeks, as you were mentioning. And this is really weighing on investors and the shares, quite frankly, because it shows that the fundamentals are in a difficult spot. And it's the biggest, it's the second slash in about 3 months, as I was just mentioning. They cut prices by about 10%. Now, in dollar terms on the Model Y, the SUV, this equates to about $38,000. I never knew you could buy a Tesla for so little, and that's because it's 43% below the most basic model here in the U.S. So it really shows that China's bet is struggling to some degree. And it's not just China where they cut pricing, also in Japan today and Korea. Now, relative to the manufacturing, last year they shipped over 700,000 EVs from Shanghai, 54% of its worldwide sales. But that has really declined more recently. In December, deliveries slowed to 56,000, just half of the November number. Production suspended for a number of reasons. Now, the big question here, and take a look at this chart, John, just incredible, down 71% over the last year. Who knew that could happen to Tesla? Taking an important level of support around 110, now heading most likely to 95, if not lower, depending on whether the buyers will finally kick in. Valuation is attractive here, but relative to the upcoming earnings, this news less likely to weigh. It could impact more into the April report, but either way, folks really on pins and needles, eggshells, waiting to see what comes out of this company, as the fundamentals do seem to be deteriorating, at least relative to China.
Abby, thank you. 2 minutes in, that stock is down about 6% on the session. It's down around 16% on the week. We'll stay on top of that for you. More signs of corporate pain ahead, this time for Southwest, expecting to report a net loss in the fourth quarter after thousands of flight cancellations in a previous month. Kelly, that stock down about 0.9%.
Yeah, we're adding to losses Southwest has already seen over the course of the last several weeks, John. 16,700 flights, even more than that, canceled over a 10-day period over the holidays. So we knew this was going to have a pretty serious financial consequence, but perhaps it is going to be one larger than anticipated. As you said, they do expect to report a loss in the fourth quarter. Through yesterday, even though analysts had taken their expectations down by about 16% over the last 4 weeks, they were still expecting a profit of around 67 cents a share. So this may be a bit of a significant downside surprise here. The company saying that the meltdown had a negative impact in the range of $725 to $825 million. Now, part of that from lost revenue up to $425 million, but the rest of the hit coming from an increase in operating expenses, and that's primarily tied to reimbursements to customers. So this dragging on the stock that already was down about 15% over the last month. It is worth noting as well that it had already been underperforming its peers even prior to this holiday episode. Southwest is the orange line here on this chart compared to the S&P 500 Airlines Index in white. Over the last 6 months, Southwest down 6%, while the rest of its peer group is actually up by about that much. So this episode, John, just something that set them even further back when they already were sitting out to a certain degree some of this recovery.
Kelly, thank you. About 3 or 4 minutes into this then, the broader equity market positive at least, up 1% on the S&P. On the Nasdaq, up 0.8%. Behind us, the jobs report. In front of us, the next stop is CPI on the 12th. After that, the 13th is JP Morgan. The big banks kicking off earnings next week. A growing consensus on Wall Street expecting a bit of an ugly season. Citi's Kristen Bidley looking for 10% falls. Bank of America's Savita Subramaniam seeing 15% downside from consensus for tech alone. JP Morgan's David Lebovitz pushing back.
So the great debate is about earnings. I recognize that if we have a recession, corporate profits are going to decline. I think it's more about pricing in that magnitude of decline, and I think people may be overly pessimistic, not recognizing what inflation does for revenues.
Mike Collins, Anastasia Amoroso back with us. Anastasia, we came into this year, you said this year offers investors a fresh and better entry point. Where's the earnings story in that?
Well, the earnings story is that earnings expectations have already reset a lot. I mean, if you look at the S&P 500 next 12 months, or actually 2023, the expectation was for $250. That is now reset to $231. So to David's point is that we've already seen a pretty meaningful reset. There's another way to look at it, which is what is the ratio of upgrades to downgrades? And of course, the downgrades have been really, really meaningful. So on the bottoms up level, a lot of the estimates have already been cut back. And even when you look at things like software and semiconductors, I know some have suggested that there's still more pain to come, but even they have been through several quarters of downside revisions as well. So I actually think that a lot of this may already be in the price, and we have seen a major reset in valuations. Now, I don't think you're going to hear great rosy things from companies, tech or otherwise. I think what you're going to hear is some downbeat guidance and conservatives because, I mean, look at what happened with GDP projections. They were 2% for this coming year, and now they're 0. So I think companies' guidance will reflect that. But to me, one of the most optimistic things that may come out in this earnings season is companies are going to be focused on maintaining their margins. And markets are going to like that. If companies actually, unfortunately, lay off workers and trim back CapEx and roll back the buybacks, they're preserving their margins. And I think markets will see that as a positive development.
Well, let's talk about those corporate decisions so far, Anastasia. Zuckerberg, Jassy, Benioff, all making cuts. Others as well in big tech. Is that sufficient to make you constructive on that sector?
I think it is definitely heading in the right direction. So first of all, what happened to tech margin? If you look at the S&P 500 infotech sector, the margin was one of the highest in the S&P at 23%, and that has been under pressure over the last few quarters, coming down to 21%. Now, this is not the first time tech has seen margin pressure. And by the way, communication services are seeing that too. We saw that in 2020, we saw that in 2018, and 2015, 16, before that. But what happens is once you start cutting costs across the board, you can get that margin higher, and that tends to be what the market participants focus on. So I think there's still some ways to go in order to engineer a margin turnaround, but that's the very, very first thing that needs to happen is change of direction. John, what I like about tech is obviously the tech valuations were through the roof back in 2021, but that has reset a lot. I mean, you look at semis, they were trading at 25 times multiple. That's at 17 times today. You look at software, that was trading at 20 enterprise value to revenue multiple. That's now 5.5 times. So we've seen major resets. And, you know, I'm not saying that tech is going to reach escape velocity in the first half of the year, but if everybody's so optimistic on the second half, then the time you actually want to be inching into the space is now, is the first half of the year.
We caught up with Brent Thill of Jefferies. Take a listen to what he had to say on this sector.
It's been pretty consistent across tech. So this isn't shocking. The magnitude should probably be higher. It may end up being higher. Jefferies is forecasting a more prolonged recession and a later start to the recession, which is bad news, meaning this just gets dragged out potentially even into 24. I don't think this is the last cut. Tech has been in a mode of just growing at any cost, and that game is over.
Mike Collins, he thinks this cyclical test can continue. He appreciates the view of Anastasia that maybe this point might be a buy, but with a 3-year time horizon, this year could be difficult. Mike, we've got a challenge to the Goldilocks view as well. I just got a message from a Bloomberg subscriber who wants to understand from your perspective. Here's the question on Goldilocks. Does Goldilocks and that view require a pause here from the Fed, or is it inclusive of additional QT and the additional hikes that are likely coming?
Yeah, Jonathan, I think, like I said earlier, if the Fed keeps pushing and tightening financial conditions and gets that funds rate into the 5s and continues to do aggressive quantitative tightening, I think the chance of the economy rolling over into a harder landing is significantly higher. I think they could stop right here, continuing to let the balance sheet roll off. I think that's sufficiently tight financial conditions, and I think that would be the best chance of engineering a soft landing. I think what's going to happen is they are going to overhike to 5 or maybe a little bit above 5%, and then they're going to have to cut rates a lot. And that's kind of what's priced into markets, not this year, but in the out years. The markets are, you know, calling the Fed's bluff and saying you're going to have to get back to 3 pretty quickly and keep it there for a long time. And I think that's probably the right level.
Well, Mike, you're going way beyond this year, way beyond next year. You said this: we're setting bonds up for strong returns in the decade ahead. Mike, why a decade call right now? What's going on?
That's what bond investors do, Jonathan, right? When you buy a 10-year bond, I mean, you're holding it generally for 10 years and looking for that long-term return. Our clients are long-term investors. Your Bloomberg aggregate bond index, Jonathan, 20 years ago yielded about what it yields today. It yielded about 4.5%, which is what it is right now. The subsequent 10 years generated a return just over 5% annualized in a really high quality government heavy index. And we're trying to beat that index as active managers by, I don't know, 1 or 2% in some cases. So, I mean, you're really setting up, Jonathan, without a doubt of a really good forward-looking return profile in fixed income.
Does that require, Mike, a return to pre-pandemic growth and inflation numbers?
Not necessarily. I mean, I think if you keep, you know, inflation, like I said, at 3, if it doesn't go back to 2 or 1.5, it stays at 3, and the funds rate stays at 3, and the 10-year stays at 3 3/4, you're clipping this yield, Jonathan. You're clipping this coupon. As Rick Reeder said, there's a lot of value in the markets in really high-quality bonds to earn 6-handle yields. I think the mistake some people make, and Rick kind of implied is you don't want to just hunker down into 1 and 2 year bonds here, right? I think if you do that, yeah, you lock in that 6-handle yield for a year or two, but who knows what the world's going to look like? The funds rate could be back at 1 or 0 in 3 years from now. So you're taking a lot of reinvestment risk by staying short. This is the time to extend duration, lock in this generational high level of yields for the long term.
Anastasia, do you agree?
I do agree. I don't think I dare to dispute Mike or Rick, but I do agree that I do think the rate volatility, the yields have peaked on the long end, because the long end of the curve is going to be sensitive to not only what the Fed does in the short term, but also what the economic growth looks like. And with economic growth expectations deteriorating, that's what's really sort of anchoring the long end of the curve. So I do like the barbell strategy, sure, being cash in cash equivalents, being some short-term treasuries, but also take advantage of the yields that had a massive reset in the longer part of the curve. And I mean, the point that really resonates with me and a lot of our clients is the fact that you can get, again, that high quality investment grade yield close to 6%. That's great. And as I think about this, you know, in terms of playbook for equity investors as well, we have a bit of a luxury right now, meaning the environment for the first half of the year is uncertain. But guess what? We have the opportunity to be defensive because we have the tools that are giving us the yield that we need. So we can camp out in some of these securities, but at the same time, the valuations have reset a lot in equities, and you know, parts of private equity market, for example, are feeling it as well. So we also have the luxury of taking advantage of these valuations over time, over the course of the first half, setting yourself up for the better second half. So this barbell strategy of being defensive and being opportunistic is really the luxury that this market is giving us right now.
Anastasia, wonderful, as always, to catch up with you. Anastasia Amoroso with the brilliant Mike Collins. To the both of you, thank you, and Happy New Year again. I think after today we stop with the Happy New Year stuff, but you decide. The market right now, those gains struggling to stick, up by a third of 1% on the S&P. The Nasdaq just about turning negative in the last 5 minutes or so. Looking at the bond market, the moves there starting to fade as well. We had a bigger move at the front end. Yields still lower, just not as low as they once were this morning. We're down by about 5 basis points on a 2-year to 441. I'll keep an eye on that for you. Coming up, the house chaos continues in Washington. We'll catch up with Labour Secretary Marty Walsh. She joins us on the payrolls report in just a moment.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies. And I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you've just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, you know, when we look for these subprime, the reason why we shorted the subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury, so you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, you know, went from 5,000 to 45,000, you know, I would be wiped out on the short side. So it's just too volatile to short.
Joining us now, I'm pleased to say, on Bloomberg TV and on Bloomberg Radio is U.S. Labor Secretary Marty Walsh. He joins us from Washington. Secretary Walsh, fantastic to catch up with you, sir. A happy new year to you. Let's get straight into the jobs report. I remember a few months back asking you, how can we get inflation down without unemployment climbing? Well, I think this jobs report is just for you, sir. Can you tell me what's in this that you think makes it sustainable?
Well, I hope we continue the steady growth that we're seeing the unemployment number come down. I think we have room to grow in communities of color, particularly the Black community, Latino community, get those numbers down a little bit. We've seen, wages are still year over year up. 4.1%. We went down about 0.1%. I think we're in a very interesting economic time, and I don't think that a recovery that we're used to coming out of a recession or going into a recession is compatible to what we're experiencing today. So I hope we can continue to see these job numbers moving forward. We saw good gains in construction, hospitality, leisure, education, and health. Those areas in the last couple of months we haven't seen the growth we've seen today. So we just want to see it across the board. I think companies realize it too, that it's important for us to continue to move our economy forward. They're bringing people on, and we need to keep bringing inflationary pressures down.
It's not just the numbers today, it's the jobs numbers we've seen all week. The job openings numbers still elevated, the quicks rate elevated, indicating some confidence. I'm looking at this at the moment, Secretary Walsh. Then I listen to the tech companies who are making these massive layoffs. How do you distinguish between what's happening there and what you see in the official data?
Well, I think the tech companies are actually looking the way their business models are. They're looking at how the inflation rate impacts their business. And a lot of these folks that are being laid off in the tech industry are finding jobs in areas that, quite honestly, people are looking for tech experts all across the country. But these tech companies had gobbled up so much talent. Certainly, I would like to see short-term, in the near future, these tech companies rehiring folks back. We don't want to see any industry in the United States of America going through a process of laying large amounts of people off. We want to see them all being successful.
A lot of people arguing that we have still a tight labour market, and with that, Secretary Walsh, you and I have been talking about the return of labour power, so let's touch on that a little bit. Can you give us an update on the West Coast port situation? We've gone back and forth on this for, I think, about 9 months now, Secretary Walsh. What's going on and how close are we to a deal?
Yeah, I went out there. I was out there this week, actually, Monday. I went out to the West Coast ports. I had a meeting. I walked the port in L.A., in Long Beach, and we had good conversations. I asked both sides, the union and the company. They're back at the table. They're moving forward, and they're having conversations and dialogues. And, the one thing I did ask them, they didn't give me a date. I'd like to see, the quicker we can get this resolved, the better, because it will bring a little peace of mind to people, particularly in industries of shipping. And I think that, I think both sides are committed to getting it done. I'm not concerned. This is a very different situation than the rails. The rails were a situation where both sides, in the beginning of the conversation, weren't having conversations. In this particular case, the shipping companies and the unions have been talking consistently all along.
What would make you concerned?
If we don't, what would make me concerned if they have a breakdown in conversation. This contract, like the rail contract, is a massive contract. There's lots of different pieces to it. But if one side indicated to me that they felt there was an obstacle in the way, and that's not the case, at least not of yet. I was, when we started talking about this in the very beginning, I was hoping that we'd have a contract by Labor Day, but clearly I was very wrong.
Well, we've got to wait, and hopefully we don't have to wait too long. Another story that involved the union movement, Secretary Walsh, that you're also involved in, ConocoPhillips. You're aware of this situation with its Alaska operations, this $8 billion oil project in the Arctic. On the one hand, you've got huge union support for the project. On the other hand, the environmentalists hate it and want more involvement from the administration. Where are you on this, Secretary Walsh? Do you have a side in this one?
No, I haven't necessarily had a side in this one, but I was asked earlier, and the labor unions are certainly putting lots of pressure and calling me on this all the time because they're concerned about it. So we're kind of seeing, as we move forward here, what's going to happen.
Is there a compromise, and what does that compromise look like?
I'm not that involved in the conversation, so I can't answer that question if there's a compromise.
Okay, final question to you then on the situation in Washington. Struggle to vote a House Speaker. Secretary Walsh, as someone who works in the administration, I think this is important. I saw some criticism of the situation in the United States from Chinese state media. And I asked the question at the time when I saw that criticism, what would we prefer? Some of the features of democracy where you get some chaos, or what takes place in dictatorships? And I want to understand from you, do you see the situation in the House right now, Secretary Walsh, as a feature of democracy or something worse?
Not yet, but I do hope that the Congress can get a Speaker of the House, even somebody that I might not agree with completely, but we need to get our government up and running fully, certainly. And I think that the Republicans are going through some challenges right now, and they're trying to figure out what's going to happen there, and hopefully it'll be worked out shortly.
Secretary Walsh, we appreciate your time, sir. A happy New Year. We'll catch up soon, no doubt. Thank you. Secretary Walsh there from Washington, D.C. Just want to turn to the market briefly, about 22 minutes into the session, and take a look at the equity market for you on the S&P 500. Coming into the open, we were much higher than this. We're up only 1/3 of 1%, not even that now on the S&P. The Nasdaq down by about 1/10 of 1%. We discussed that big rally into the bond market, just not as big right now. Your 2-year yield is down about 5 basis points on a 2-year to 440. With us and following the conversation with Secretary Walsh's AMH down in Washington, Anne-Marie, we heard from the President as well in the last 5-10 minutes. I imagine they're happy with the data so far.
Yeah, John, it's just another day of really incredible counter program the administration couldn't have planned if they wanted to. You have an unemployment rate of 3.5%. The president heralding this as great news, as you heard there from your interview with Secretary Walsh. At the same time, later this afternoon, the president is going to be giving out medals to these police officers that defended the Capitol on this day 2 years ago. And very much so, Jonathan, another dichotomy that is happening today at noon in Congress. Some of those individuals that actually sympathize with the insurrectionists on January 6th are the same ones that are holding up the progress of the Republican Party and Kevin McCarthy to become Speaker of the House.
Well, let's talk about the latest from Kevin McCarthy and that latest effort right now. AMH, where is it, and how many votes are we into this?
Well, at the moment, no one has publicly come out and said that they are going to be switching their votes. There's reporting, there's some from the Washington Post overnight, that there does seem to be that there's a number of individuals are starting to ease up and potentially will switch their votes. So if he goes to this first round, he's not likely going to get it, but maybe it does show some momentum and progress for him to clinch it either later in the day or this weekend. Jonathan, there's one key issue, though. There's about 4 or 5 holdouts that are absolutely never Kevin's, meaning they're going to have to do some interesting arithmetic to try to get him over the finish line. There are a lot of reporting is that this morning, in the next hour, Kevin McCarthy and his leadership team is going to be discussing with their caucus exactly what the rules procedures would look like. This goes through the details, Jonathan, of those concessions he had to make with these Freedom Caucus members and these never Kevins to try to flip their vote.
AMH, at what point does he walk away?
No one knows at this point, right? Because we've never seen this. At least we haven't seen it in more than 100 years that it's taken this long. Today will be the 12th vote to try to get a Speaker of the House. And Jonathan, most speakers don't come to the floor if they don't have the votes. So we don't know what happens yet. But if today does not go well in terms of momentum and progress to slimming that margin of the individuals he needs to get to that special number of 218 if everyone votes, then at some point there could be even a rebellion from the moderates and the centrists that say you've given away the kitchen sink and you still didn't get over the finish line. We have to look to Plan B.
Super busy close to the week for you down in Washington. Anne-Marie, thank you. AMH there down in D.C. I talked about that fading rally in the equity market. Just about positive now on the Nasdaq. The S&P up 0.4% with some sector price action. Here's Abby.
Well, John, it's interesting. Very quickly, we do have that fading equity action, but most sectors are higher. So if we go into the Bloomberg and take a look at the IMAP, we will see that consumer staples, materials, energy, all higher. What's dragging? Consumer services, discretionary, and healthcare, but mainly Microsoft, Tesla, Amazon, those big names. On the week, we have a few others that are down sharply. Autos, based on Tesla's decline, and then, of course, software and the FANG. So it's some of the big tech weakness continues to weigh, John.
Abby, thank you. This equity market rally fades then in this bond market. The rally fades there a little bit, but still bid at the front end. We're down 5 or 6 basis points on a 2-year to 440, on 10s down 2 to about 369. Let's get you the trading diary. What you need to be watching into next week. ISM data at the top of the hour. The House reconvening at noon Eastern. A host of Fed speak. Cook, Barkin, Bostic, George throughout the whole day. Next week, Fed Chair Jay Powell speaks on Tuesday. US CPI and another round of jobless claims on Thursday. Then bank earnings start next Friday. We're hitting the ground running in 2023. From New York City, have a fantastic weekend. Thank you for choosing Bloomberg TV. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one, and through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking, the bus was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison.
Connection lost.
But it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake. right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it and I just watch it until it stops going up and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
The Fidelities and the Schwabs and the E-Trades of the world, they look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
This is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interests of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
Usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1,
and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists